It is 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Brad Smith here with Rochelle Akufo this morning. Here are three things that you need to know to start off your day. Stocks limping to the finish in what's been a rocky August. The jobs report punctuates a busy week of data for investors, and now that Jay Powell has spoken, it's the next big catalyst. Will the number provide more clues as to the Fed's rate trajectory? And this number, it's going to come amid a somewhat fractured outlook on where we go next. Bets on the Fed moving in September only sit at around 20%, putting the November meeting in full focus. The China slowdown story isn't getting better fast. Despite the best efforts of policymakers, a slew of actions were announced over the weekend, including a reduction in the levy charged on stock trades and lower deposit ratios for margin financing. The numbers tell the real story, however. Investors have pulled over $10 billion from China's stock market since the turmoil began. Look at the impact on the U.S. companies. That's coming forward in this show. We're going to look at companies from Nike all the way to Caterpillar. And third, we're keeping a close eye on crude amid a confluence of potential drivers. Firstly, rates being higher for longer. That's not great news for the commodities complex. We're watching out for a tropical storm, Idalia. It's expected to hit Florida as a hurricane. And of course, there's the China slowdown to add to the mix. For some, maybe the biggest demand issue on the horizon, perhaps. We'll look at what all of this means for gas prices across the nation. Michelle?
That's right. Now, August is very much living up to its reputation as a lousy month for markets. The S&P 500 has sank more than 3% so far, on track to post its worst monthly performance since December. So what's behind the slowdown? Well, lower trading volumes as folks soak up the final days of summer. Now, that means more volatility from those who are still on the desk. And of course, China's sluggish recovery and soaring U.S. Treasury yields aren't helping either. As August winds to a close, what will it take to snap the market out of its end of summer slump? Joining us now to discuss is Paul Grunwald, S&P Global Ratings Global Chief Economist, and Michelle Schneider, MarketGauge.com Chief Strategist. A big welcome to you both. So Michelle, I want to start with you looking at the month that was in August, obviously the tail end of earnings season, and then that hawkish but cautious tone we got from Jay Powell. What are the key things, the key takeaways from you as we wrap up this August?
Well, actually, I think that it's doing a lot better than what I would have assumed at this point in time, particularly if we're looking at areas like, well, obviously the growth stocks, which have come off, but not too terribly. And of course, the small caps, which is really where we have our major focus, that have held up relatively well. Are they near recent highs? No. But are they at threatening areas at this point? They looked like they could be last week, but then the buying came in. So at this point, I think that if we can get through this week relatively unscathed, we may be in for a good surprise for September.
Paul, I want to get your take on this as well. When you think about August and the month that has been, how would you summarize it?
Right. Well, I was focusing on the Jackson Hole conference and listening to Jay Powell, and I think the theme of the year has been resilience. We are 525 basis points into a Fed tightening cycle, and if anything, growth looks like it's picking up. We printed 2.4 for the second quarter. Those data came out, and the third quarter is tracking between 5 and 6, if we can believe the Atlanta Fed's GDP Now tracker, and that suggests that the Fed may have more work to do on rates, and that's why Powell was talking tough in Jackson Hole earlier this month.
And Michelle, I mean, we heard Powell mention, potentially holding rates, potentially raising them as well. Didn't hear anything about cuts, though. How are markets digesting that information?
Well, again, not only surprisingly well, but you have, if you're looking at the long bonds right now, they've actually rallied after the Jackson Hole comments. And even though they're not exactly wowing in terms of their performance against, let's say, the S&P, that's actually relatively good news for the market in that it shows that we are still in a risk-on environment. As long as the long bonds underperform the S&P 500, that's a risk-on situation. So I don't think we really know, and I'm not going to pretend to know as much as Paul in terms of the economics part of it, but just from a logical standpoint, just like we didn't really see the impact of very low interest rates until after COVID, when clearly inflation got out of control. I don't know if we really know 2 years in whether or not this higher for longer, what kind of impact it's going to have. But at this point in time, right now, the market seems to be relatively dismissive, except for pockets of what's happening here with the rates, and even if they go another 0.25%.
Let's give yourself some credit as well, Michelle, here. I mean, you are a student of the game and no doubt long studied the economy here. So I want to give you props where props are due. Of course, Paul, just to really kind of put a fine point on what Michelle was saying as well, and kind of pull this back out to if there's anything that we can extrapolate from what's already taken place over the course of this year as we're kind of staring down this final quarter set to begin in, I don't know, 4 weeks. At this point, is there anything that we can take from the first 9 months of this year and say, okay, for the last 3 months, that where you've got a consumer that the Fed is going to be watching, where you've got a lot of corporate balance sheets that might continue to be restructured going into next year, what that spells out for the economy at large, even as we begin 2024?
Yeah, I think the surprise this year has been, one, the resilience, but two, the Fed's been kind of dragging the market behind it. You know, we've gone through a couple of decades with the Fed put or the Bernanke put or the Powell put or whatever. And this tightening cycle, the Fed's been dragging the markets higher. The market seems to fully buy this now, that we're going to keep rates higher for longer. We don't see the market anticipating any cuts until next year. And if you look at the CME forwards for the end of 2023, they're right where they are currently on the Fed funds rate. So I think we're going to be at or near this rate for a while into 2024, and we'll see if the resilience holds up. The labor market is still quite tight, and growth looks very good right now.
And Michelle, what are some of the catalysts that you're potentially looking at as we do continue to get more data coming out between now and the next Fed meeting?
Well, I think inflation is certainly something that shouldn't be dismissed, even though we have seen pockets of it obviously settle down. There are still areas of concern. I mean, wages would certainly be one, and we have a UAW strike possibly happening. And of course, it's all about wages. And we have seen a movement across not just the country, but the world about wages, trying to keep up with the price of inflation. And we still have, obviously, geopolitical concerns to worry about. And we also have weather concerns. I know you mentioned the storm at the top, but that's just one of them. We still have persistent drought. And if you just look at things like the price of sugar, which comes a lot from India, they are holding back on exports, as they've done with rice and they've done with onions. So there's a lot of similarities. People have been talking about the 70s, and now we've been talking about it for quite some time. But now it really seems like exactly what kind of happened at 76. Looked like we were going into a recession. There was a very substantial Fed hike at that point. They eased up. And then, of course, as we know, inflation kicked up again. We have some similarities. That, to me, is going to continue to be my concern until I see conditions change.
All right. No doubt has been a very interesting August to watch, especially as we've kind of grappled with some of the volatility that has ensued here. No doubt been a good August for Paul as well on the pedometer, or at least on the Peloton, I will say. 1,001 kilometers, right?
On the real bike, Brad, not the Peloton, on the real bike out in northern New Jersey, right?
There we go. All right, solid month nonetheless. Hey, stay with us, Paul and Michelle. This week, we'll see the last big reports to be before the next Fed meeting on September 20th. Now, with more housing data on Tuesday and Wednesday, the Fed's preferred inflation print, PCE, reporting Thursday, as well as jobs day on Friday. You got a lot of stuff going on. We're going to be looking at some final big drivers of Fed moves for a few weeks. Let's bring back in Paul Grunwald, who is the S&P Global Ratings chief economist, and Michelle Snyder, who is the MarketGauge.com chief strategist. Okay, Michelle, I want to go to you first here as we kind of look at the week ahead. No doubt, the jobs report going to be taking a lot of the air up in the room, but PCE also important to watch. What's the expectation as we're coming into that?
Well, as far as the PCE, I think that we probably would not be surprised to see some kind of a raise, because after the last report, we have seen gas prices in particular and oil prices go up, and that's a big factor. As far as the jobs report, I don't see any reason why that won't remain also strong. The jobless claims that we've watched over the last few weeks are in a range, essentially nothing too dramatic in terms of jobless claims rising or falling. So if we're going to go in with the anticipation that PCE comes in maybe a little over 4.1%, I think that's about what we're looking at, and the jobs report remains robust, then yeah, you might get another knee-jerk reaction for the market being nervous about a September hike as opposed to November. But once again, I think we'll go back to where we're at right now, which is the market has gotten used to this, and without some other major watershed event, it should be absorbed.
So, Paul, as we look at the sort of new normal, we've gotten used to this higher for longer environment, but you still have a very tight labor market and still see some stickier portions of core inflation as well. And this is after more than a year of rate hikes. What breaks this holding pattern, or is it going to be sort of a slow and steady decline to get to that 2% inflation target for the Fed?
Right. Well, breaking. I think if we continue on this path where unemployment's about 3.5 and PCE inflation's around 4, that's not good enough, right? That's an unsustainable path where inflation's too high relative to target. And it's great to have unemployment at 3.5, but that's not sustainable with price stability either. And Rochelle, to your question, the issue is whether we can get to the 2% target in a smooth way, or we get there abruptly, which would imply a recession. We think, given the resilience of the job market and the economy more generally, we can probably engineer some sort of soft landing. But what needs to happen is financial conditions need to get a little bit tighter, right? Real interest rates are not particularly high. Financial conditions are not particularly tight. And we kind of heard that indirectly at Jackson Hole, not just from Jay Powell, but from Christine Lagarde and others. So they were doing what we would call open mouth operations, right? They were talking kind of tough, but the market needs to tighten those conditions further so that we get a deceleration of growth. And that's what we're really going to be watching throughout the rest of the year, to see if we can get, a gradual rise in unemployment and a continued downward trend in inflation toward 2. We're not going to get to 2 for a while.
Just to add on to that, Paul, what about wages? Where does the markets need to see wages move in order for them to be kind of an all clear that the Fed perhaps has a little bit more direction that's given to it by the economic data that comes out this week?
Right. The working number for the market is 3.5% for wage growth. And the way we get that is the 2% inflation target and then productivity, which we all know is kind of difficult to measure. But that's kind of 1.5%. So if you add 2 and 1.5, that's how you get your 3.5. We're still north of 4. So again, if we can let the air out of the demand balloon kind of gradually and get that down into the mid 3s and then get inflation trending down and maybe unemployment drifting up, that's kind of the Goldilocks scenario. But we ain't there yet.
And Michelle, how is some of the data informing your GDP outlook and potential revisions?
Say of all the numbers right now, I find that to be maybe the most suspect because of all of the revisions. What we could see here, obviously, on the heels of things that we actually know, which is how much money has been spent towards manufacturing and infrastructure, and also, of course, how much government debt is involved with that, and consumer spending, that we're seeing some level of growth. But I'm not necessarily thinking that that's going to be sustainable, given exactly what Paul just said, is since we're not there yet in terms of a 2% inflation target, which many people believe that they would actually change, doesn't look like they're going to. And we go back to history, what we can say is that we have different types of pressures now than we've had in the past. And so what the Fed might really want to do is nothing until we see some of these pressures really start to bubble, in which case then they would have to become more aggressive and actually really throw us into a recession. So GDP is a factor, but not necessarily for us the big factor right here.
Paul's sitting about an arm's length away from me right now, and I see him nodding his head as you were speaking there. Michelle, Paul, you want to add on to that real quick?
Yeah, I think what the Fed would prefer to do now is keep the nominal policy rate about where it is. So if we get a gradual decline in inflation, that means real rates, which is the nominal rate minus inflation, that's going to be rising gradually and just sort of slowly squeeze the economy. And that's kind of the recipe for a soft landing. What the Fed doesn't want to do is see another burst of inflation where they have to aggressively raise rates again. That's gonna raise the probability of a harder landing. So if they can stay around where they are now, and then the inflation comes down and then the real rates come up, I think that's their scenario. And also, let's remember, we're still kind of licking our wounds after missing the inflation impulse back in 2021. So if anything, the Fed and other central banks are probably going to be leaning a bit higher and stronger just to maintain their credibility, because the last thing they want to do is kind of have another pickup in inflation. So we think that's broadly the outline of the soft landing scenario.
And Michelle, do you think that markets are correctly pricing some of these risks in?
Well, I think if you look at certain pockets of the market, they're much more concerning. For example, if we just take a look at the narrative of the strong consumer, but we look at the ETF XRT, which I like to look at because it's a basket of both staples and discretionary. It really has been and continues to underperform the benchmarks, the indices in particular, and the SPY. Is that something like a canary in a coal mine? Possibly. Could it play catch up? Definitely. But that would really be something that I would keep a strong eye on, would be that whole retail sector going forward. And then I think we'll have a better idea of whether or not the market is really going to be able to sustain these levels, or we're in some kind of a la-la land because, as Paul just said, the Fed is just going to maintain this and we may have a chance of a soft landing. And I don't think we can also underestimate the fact that we're going into an election year. I'm not quite sure how that plays into it all, but I would think that the government would do whatever it can to keep us out of a recession, because that would not be very good for a potential Democratic reelection.
Yeah, and if I could jump in, I didn't want to leave the impression that the entire economy is doing well. We're seeing a very strong services sector, but as Michelle just alluded to, in parts of the economy, we're seeing some weakness. Anything that's kind of interest rate sensitive, I think commercial real estate would be exhibit number one in that particular narrative. But she's also right. We're coming into an election year, and the Fed's an independent central bank. They're independent within the government, but we can envisage a scenario where there might be some pressure if things start to soften next year, but that's to be seen.
Indeed, we do remember former President Trump putting a lot of pressure on the Fed, although the Fed, staying independent, but obviously was getting a lot of political pressure. Well, hold that thought. Stay with us, Paul Grunwald and Michelle Schneider. You'll be back with us in just a moment. Now, we're going to take a look at Chinese stocks. They're seeing some relief this morning after government officials announced cutting a tax on stock trading. Now, the move attempting to restore confidence in the world's second largest equity market. But China's ongoing woes are still raising concerns. Foreign investors have already pulled billions of dollars out of China's stock markets, and the street remains skeptical on China's faltering economy. Investment banks Goldman Sachs and Morgan Stanley have cut their targets for Chinese equities. Let's bring back in Paul Grunwald, S&P Global Ratings Global Chief Economist, and Michelle Schneider, MarketGauge.com Chief Strategist. So, Paul, I want to start with you because a lot of people wondering about some of the most exposed sectors and industries, U.S. industries, as they're keeping an eye on what's happening with China and this propping up that policymakers are trying to do. How would you connect those dots?
Yeah, well, the U.S. is basically, it's a closed economy. It doesn't depend too much on the rest of the world. But the China story is big, right? China's been the number one driver of global growth for a couple of decades. It's basically an investment-led economy. We had a narrative over the last 6 months or so that China would have a consumer-led recovery, and we normally don't kind of use that phrase with China. So that spills over a little bit in terms of tourism and maybe luxury spending, et cetera. But if the investment part of the Chinese economy is soft, and some people put the property sector broadly defined as something like 1/3 of the Chinese economy. If that's going to slow, there's a lot of kind of spillovers in terms of mineral demand and other demand and capex goods demand and stuff like that. So I'm not sure the U.S. is hugely exposed. Some of the data I've looked at suggests countries like Germany might be more directly impacted by a China slowdown. But if the number one driver of global growth downshifts, we're going to get slower global growth, slower global commodity demand. China's the biggest oil importer in the world and energy importer in the world. So that's definitely going to move the global macro needle.
And Michelle, to what extent is softness in China also kind of firing off bells and whistles in the U.S. markets or equities as you're seeing them in Market Gauge?
Well, what's interesting to me is this is really also, I think, another example of a lot of bad news. And then yet, if you look at the technicals, although we could all say that China has been also well underperforming the U.S., it's holding up very good, or I should say way better than one would anticipate. It's actually coming in higher today. So I think it's really kind of hard to know. Now, I do know that the U.S. is taking a very hardline stance, but there's a couple of things that I find interesting about China. One is we know that they take a very long-term view on things. They're not like we are basically influenced week to week, quarter to quarter, statistic by statistic. Yes, the real estate has been under pressure, and with Evergrande, from what I've heard from people, that's been more of a restructuring. It's a Chapter 15, not a Chapter 11. And that, even though they're having some issues here and still much longer in terms of coming out of the COVID situation, which I think is a factor, I wouldn't necessarily discount them. They're doing tremendous amount of buying. They bought $5 billion worth of NVIDIA chips for their AI. So, and BRICS, let's talk about BRICS. I mean, I think they're the number one influencer right now, if there's going to be any traction with BRICS, which to me, the most insidious part, besides the obvious, is that there is this organization of countries that are trying to fight against the West. So I'm looking very cautiously at what unfolds there in terms of China. We actually shifted a lot of our interest into Vietnam because that has actually been doing better as a place where we're doing a lot more manufacturing since we're not actually working as much with China. But nonetheless, I wouldn't discount it just yet. And if that FXI can get back up over, say, 28, it's trading at around 27 right now, that would mean technically it's not as bad as people think.
And Paul, to Michelle's point, especially as we look at chips and some of these national security issues that have now become political issues as both the US and China really want to secure their economic future based on a lot of this high tech, what position does that put some of the companies, some of these multinational companies that have exposure to China, especially as they do seek to perhaps turn towards an India or a Vietnam to keep their options open?
Yeah, well, I think that dynamics happening at both the country level and the firm level, right? So a lot of countries have exposure to China. A lot of firms have a lot of business in China. There's geopolitics between the big two, which is the US and China. We have China plus one strategy. So some of the production might be moving to a Vietnam or an India, or maybe even closer to home here in Mexico. So everyone needs to figure out how to kind of navigate this new world. I think we've got a set of security issues around high-end chips and maybe some of the strategic minerals that aren't going to go away, but there's still a lot of scope for the two countries to compete economically. I don't think we've kind of rested on the final model for that, but we have to find something that works. I wanted to come back to one point that Michelle brought up very quickly, which is the BRICS group. A lot of airtime has been sort of spent on this. I don't think there's any threat to the US dollar as the world's reserve currency or the US Treasury as the world's global store of wealth, but we do have a sizable chunk of countries that are trying to maybe develop an alternative system, but we really don't see a big risk to the top status of the US currency or the US government bonds anytime soon.
Just to follow on, how would we see that kind of as we were kind of framing out going into 2024, now that we're essentially kind of looking at where China and where some of these partnerships actually may have a more profound impact in 2024, which is an election year, as we had put on the table earlier. It sounds like one of the things that may swing the markets is what political candidates could be saying about China as well. Is there anything that you believe, Michelle, that could rattle the markets as we get into heavy campaigning and the international and foreign relations that are going to be coming about, at least in talks leading up to that point in time in November of next year?
Well, I certainly hope Paul is correct on the analysis in terms of BRICS, that most likely the influence, although growing, is not going to really do any damage to the dollar as the world's reserve currency. But when I was reading all the headlines last week, and clearly the dollar hasn't fallen apart. I mean, it's well off its highs, but it's still doing relatively well. What bothers me about this, and what I think in terms of policy could actually make this worse, is exactly that. Is that the U.S. right now is basically poo-pooing the whole idea of globalization and going more into the deglobalization, which, by the way, it's in and of itself is inflationary, but that it could potentially push the alliances of the BRICS country further into wanting to do damage. And let's face it, to me, the most effective damage you can do to the United States would be through its pocket, as opposed to talking nuclear or any of the other combative type of situations that we've seen in the past. This is a different type of potential. And I'm just putting it out there. I am not necessarily saying it's going to happen. And God knows I certainly don't hope it happens. But it is certainly something I don't necessarily would readily dismiss if we have too much hardline policy here in the U.S.
Yeah, in all of our own very U.S.-centric, biased opinions, we would hope that it does not happen here. Thank you so much, Michelle Snyder, MarketGauge.com chief strategist, and Paul Grunwald, who is the S&P Global Ratings global chief economist and weekend warrior on the bike. All of your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
Was NVIDIA the spark that growth stocks needed to reignite?
We'll know that for sure over the coming weeks, but it certainly doesn't hurt. I mean, NVIDIA has been the catalyst pretty much for most of this year in terms of sparking, ChatGPT sparked the AI fever, but NVIDIA really became the way to play it. And so it does seem to sort of give an all clear or safe to get back in the water despite all the headwinds that might be hitting growth stocks. But it is a bit of it's an outlier. It's too tough to extrapolate.
Let's get to your opening bell on Wall Street in this final trading week of August. Let's get you a quick check of the markets, see how we're faring this morning. Looking at green across the board here, as you can see, the Dow was off to a soaring start with futures, but as you can see, pared back a little bit, but still up about 170 points, or about 0.5%. The S&P 500, they're also seeing similar gains of about 0.5%, or about 21 points. The tech-heavy Nasdaq, their strongest gainer out the gate, they're up 125 points, or about 1% on the day. As we take a look here, Brad, what else are you keeping an eye on this morning?
Yeah, keeping a close eye on those major averages, as well as a few pockets that I do want to dive into in a hot second here. But as you were mentioning, those major averages are shooting the Dow starting off the day higher by about 0.5% right now, continuing to just keep a close eye on some of the sectors as well, which I'll toggle over to in a hot second here. But taking a look at the Nasdaq Composite first, you're seeing that up by about 0.8%, 0.7% there, and the S&P 500, that also higher by about 0.5% right now. And then additionally here, for the sector activity that we're seeing on the day, I'll just kind of pull that up on my screen as I'm gaining some connectivity to our Wi-Fi interactive here. Taking a look at the sector activity that I'm seeing as of right now. Out the gate, looks like we're higher across the board as of this point in time, being led largely by, well, it's moving around, but communication services at this point, 0.7% in a move higher that you're seeing there. Consumer discretionary, that's also up, and that is kind of helping lead some of the gains as of right now. Consumer discretionary higher by about 0.5%, and then additionally, technology, real estate also moving higher 0.5%. So things jumping around out the gate, but net higher across the board. Also here, we got to talk about 3M, Rochelle.
Indeed, 3M has reportedly agreed to a tentative deal of $5.5 billion to settle over 300,000 lawsuits alleging that the company sold defective earplugs to the U.S. military. That's according to Bloomberg. We're seeing the stock, though, not too badly affected there, up about 5.5% on the day. I think perhaps some relief there that there is, in fact, a resolution on track, perhaps helping keep the stock afloat today.
Absolutely. And, you know, one of the huge things around 3M that's important to remember, too, especially given the faulty earplugs and the $5.5 billion settlement to resolve some of those claims here. The company, we're waiting for more of a response. They're also, of course, in the process of spinning off the healthcare division. That's set to come later on in 2023, so towards the end of the year there. And then additionally, they've kind of had this history of, you know, where some of the chemicals that the companies produce and, you know, some that are, you know, ultimately involved in the broader manufacturing. There is kind of a track record or a history where there have been some of these settlements previously in the past, but at the end of the day, it'll be interesting to see exactly how investors continue to kind of weigh in around this potentially. But investors, perhaps looking at this and saying, all right, it could have been worse. So shares are up by about 6.7% right now, Rochelle.
I think you're right. That could have been worse mentality seeming to stick there, as we're seeing 3M not really affected by it. Let's also take a look at what we're seeing with shares of XPeng or Xiaopeng moving higher today after the Chinese EV company announced it will be buying Didi's smart car development business in a deal worth $744 million. For more details, we're joined by Yahoo Finance's Pras Subramanian. Hey, Pras.
Hey, Rochelle. So yeah, this is actually an all-stock deal where Didi will own 3.25% of XPeng following this stock transfer. But yeah, basically, XPeng is getting Didi's expertise with ride-hailing and autonomous technology. And as part of the deal, XPeng will launch a new EV brand with Didi called Project Mona. The cars will be relatively cheap, around $20,000. The companies will work together on marketing, financial services deals, charging, and of course, a robo-taxi network. So for Didi, it's sort of, the company had faced setbacks in its EV and autonomous endeavors here. This is perhaps a way forward for them to work with XPeng. And remember, Didi was delisted from the NYSE last year during that Chinese government crackdown. So for XPeng, it's another big deal for the company now. They just signed a deal with VW for around $700 million to make a couple new EVs for the Chinese domestic market. So another thing here, another big peg here for XPeng in China.
And then additionally here, Pras, when we think about the moves that are set to come forward, I mean, we're set to not just watch XPeng, but we've also got NIO reporting later on this week. So if we think about these EV plays within China and how they're starting to kind of make themselves not just more known, but where consumers are gravitating towards them, is there kind of any clear winner that we're seeing?
Oh, it's a very competitive space. A lot of domestic players there, and I think there's this sort of struggle to see who's going to be coming out on top. And you have companies like BYD and Li Auto and other companies that do stuff like range extending cars with EVs that use batteries to extend the range of their gas engines. So that's a whole other thing that happens in China. But I think with XPeng, it's another kind of way for them to kind of notch their way higher into that space. And signing with Didi is a well-known name in China. It's kind of a big deal for them, like a feather in their hat. And then also, I think for XPeng, it's a way to get all that technology that Didi has, all that data they have from all the ride-hailing stuff they've been playing. So it's another big technology move for them. So I think it's a way for them to maybe clear the space, get a bit more breathing room, and maybe kind of leapfrog some of their competitors in that really competitive Chinese EV market.
Interesting.
And Didi has always been very creative about this. I remember when at first it was just considered the Uber of China, and then it sort of nudged Uber out of the way a bit. So to see its evolution is really interesting. What are some of the other partnerships that you think perhaps Didi could benefit from, as you do have a very competitive EV space in China?
You're saying with Didi in terms of their EV sort of endeavors, I think XPeng is a great option for them. XPeng's cars are actually pretty popular in the sense that they're very sporty looking. They're like a competitor to Tesla in some sense. They're operating at that level, not at that scale though, but definitely at that level. And I think if you partner with, like you said, Didi, who's well known in the country, it sort of gives XPeng a way to compete with Tesla and their FSD and their autopilot, which I've been hearing FSDs coming to China soon. The question is, will regulations or regulatory people allow that to happen in that country? But yeah, I think it's a big tie-up between two big companies. Think like Uber and GM joining forces, right? That's sort of what we're talking about.
All right, really interesting stuff here. Pras, thanks so much for breaking that down for us this morning. Thanks. Appreciate it. Also, everyone, Rite Aid shares, they are in focus this morning. They're slipping as the company reportedly plans to file for bankruptcy as it faces several lawsuits over the chain's alleged role in the sale of opioids, according to the Wall Street Journal here. And of course, you're taking a look at shares reacting. They are down by about 3.6%. Now, of course, just a 3-cent move or a 2-cent move gives you that kind of percentage change here. This has long been kind of an embattled longer-term story for Rite Aid, whether you think about the number of locations that they sold off years ago and just to make sure that they could kind of right-size their own structure. But then additionally, the heated competition in the PBM's business right now with CVS and Walgreens Boots Alliance really kind of being some of the standard bearers for that, as well as Express Scripts and some other names, of course, over the years. But for the majority of how this has shifted, and for some of the drugs themselves that could be more generically manufactured and, that are now in terms of a distribution, have more competition from the likes of Amazon and the acquisition of PillPack, and even into kind of Mark Cuban's Cost Plus. I think that's where it created even more of a headwind for Rite Aid now at the store level too, that they still operate, because if it's just online distribution for a company in Amazon and PillPack, they don't have to worry about necessarily the same type of storefronts, even though they could essentially take PillPack into all of those Whole Foods locations as well. All that considered though, it's been a rough go for the past several years here for Rite Aid.
It's true. I mean, you have to wonder why they weren't as nimble as, say, a CVS in having some of these partnerships. We knew that obviously with a lot of the build-up from COVID and people sort of going in to get their shots, we knew that was going to start trailing off. CVS was much more proactive about looking at these partnerships. And then when you factor in this alleged oversupply of opioids that Rite Aid has been accused of, also about more than $3 billion in debt, Rite Aid really just didn't keep up with the market. And even when you go into the stores, some of the inventory, some of the shelves tend to be a little bit emptier. So it seems like, I don't know if there was a mismatch between customer demand and inventory, but Rite Aid just not really able to right its ship at the moment, and certainly not able to make some effective partnerships in that space as well. All right, well, all your markets action still ahead. Stay tuned. You're watching Yahoo Finance.
Here's a random one. What do you make of VinFast?
SPACs are back.
Are they though?
No, they're not. But selectively they are. I mean, VinFast has everything, everything you'd want in a meme-like stock. I'm not going to call it a meme stock, but it's electric cars. It's a very thin float. It's non-U.S. based, and some of we've seen much more crazy trading in some of the new listings that have come out of Asia rather than the ones that are domestically focused. And so you've got all the ingredients. Is this company worth more than Ford and GM at this point? It seems ridiculous, but that's not. If you're trading VinFast or if you're investing in VinFast, you're not thinking in those terms. You're saying, oh wait, this stock can double in a day or triple in a day, and oh, if it goes down 50%, maybe it'll come back next time. So which it has exactly. So you've had everything in its short lifespan.
Yeah.
The S&P 500 hasn't managed back-to-back gains in August, set to break a 22-year record. For more on what could fuel the market higher, including share buybacks, let's go to Jared Blickery at the New York Stock Exchange. Hey, Jared.
Hi, Rochelle. August has been a little bit of a disappointment for equities, although we knew coming into the month that August is seasonally weak. So more on that in a second. I want to go to the Wi-Fi Interactive. You mentioned buybacks, and that is a perennial source of a potential tailwind for the markets. Here we have buybacks going all the way back to 2007, and we are tracking actually a near record. I think we're at the second highest amount in the U.S. Versus history. Here's a chart by JP Morgan showing that we are not quite at the levels we've seen in years past, but again, we do have until the end of the year. And so let me just bring up some cautionary words from the JP Morgan team talking about buybacks. Just waiting for this to come. Here we go. They see a dimming outlook for buybacks. Corporate sentiment around them has already turned less positive given limited earnings growth, much richer valuation, and the IRA buybacks tax. Despite strong buyback activity year to date, and this is the second highest on record, this relatively strong activity is less productive in reducing share count, given the inflated prices and valuation. So to say that we've had this incredible rally this year in a lot of the growth stocks, but that is diminished, that is increasing the valuations and diminishing the effects of these buybacks. I want to go back. I'm going to show another chart now. You mentioned that we have not had back-to-back days in the S&P 500. And here is a chart of the daily wins and losses going back to about March of this year. You can see some elevated volatility around the internet banking crisis back then, but not 2 days consecutive in the month of August, except to the downside. We got a couple of streaks there. All of this coming on the seasonality that we see in the third presidential year. This has to do with Ryan Dietrich's chart that I like to show quite a bit. We are right here now, somewhere in August, and we just tend to go sideways into November. So we have to see if that becomes true. But in the meantime, we do have a little bit of a headwind for the Uber bulls and probably the Uber bears too. Frustration on both sides.
Jared, how has August been for some of the riskier assets out there? And, say we throw cryptocurrency out there and Bitcoin.
Yes, the riskier assets, the fringier assets, you can throw crypto in there, you can throw meme stocks. Those have fallen off. Those have given back some of those gains that we saw earlier in the year. If we go back to the Wi-Fi Interactive there, thank you for that. Here we have Bitcoin. It's just barely positive from yesterday. But let me go back, let me just show a 3-month chart and we can see what's happened. We did kind of fall out of bed here. We broke the 30,000 level. That didn't seem to break the bank. 28, 29,000. It was a quick trip down after that. And if we look at the year-to-date chart, we've only come down to what is probably just another support level. And all of this just looks like an extreme case of the sideways going all the way back to April. So really not a lot has changed in the cryptocurrency front. If you just look at this Bitcoin chart, although we do have some developments on the court side and everything else, it's going to be difficult to think what the ultimate catalyst will be. Either the Fed increases liquidity, and you can bet this chart will go to the moon if and when the Fed finally does cut, but that could be years away, or we have another big event like a halvening, or to the downside, we got the Binance. Anything that happens with Binance and a huge regulatory crackdown on them could also bring lower prices.
And Jared, just quickly, in terms of seasonality, because we know that August does tend to be a dismal month, but when you wrap in things like, China trying to be propped up, more hawkish tone from Fed Chair Jay Powell, what should we really make for investors in terms of the mindset when we think about August?
Well, I think in general we need to be on a little bit of defense here. We're wrapping up the summer. There's not a lot of liquidity. The floor here is pretty quiet, admittedly, in the month of August. And then when we think about what happens in the fall, back to school, suddenly people's minds get in their head that they are back to business. That is a return of liquidity to the market, and that's when actual decisions have been made. I think the entire summer was basically on autopilot. There was an upper goal reached in the Nasdaq and the S&P 500. Profits were taken. There was no huge directional change in monetary policy or anything coming out of the central banks. We didn't really have a lot of surprises. Things went pretty well with the economy, and if anything, low expectations were beat. So for the month of August, I think we're kind of going to consign that one to the history books of not having much happen, and we're probably just going to be looking ahead to September, October. If you look back at that chart, just one more time here, if we can go to the Wi-Fi Interactive. It doesn't look like I'm able to control this now, so I'm not sure what you're seeing on your screen, but I was just going to show you that sideways pattern tends to continue into October and September and October. That's when we see volatility spike historically in the stock market. That's when we have market crashes. Most years, September and October is good, but occasionally you get a crash for whatever reason. We've had a lot of those historically in this time of year, so that accounts for those VIX seasonality charts that you see that go just like this towards the end of the year.
All right, thanks so much, Jared, down there at the New York Stock Exchange. Appreciate it. And to say NVIDIA stock is on fire is an understatement. Shares are up more than 210% year to date as the AI hype train keeps pushing markets forward. And while NVIDIA is in no immediate danger of losing its grip on the AI wave, rivals are looking to step up their game. For more on this story, we are joined by Yahoo Finance tech editor Dan Halley. Hey, Dan.
That's right, Brad. We're talking about NVIDIA because they obviously had that blowout quarter last week, doing an incredible job as far as their shares go this year, over the past several months as well. And then also the fact that with the AI train and AI hype wave, they're the ones that are benefiting the most. But as you said, they're not exactly out of the woods when it comes to rivals. Yes, right now they've built this kind of moat around themselves, but the rivals that they have, AMD, Intel, others that are looking into AI or working through AI. We'll talk about the likes of Qualcomm, ARM, which NVIDIA uses, also mentioning more about AI, though they're more of a supplier than anything. But when it comes to AMD and Intel, they're really trying to step up their game to take on NVIDIA. And specifically, we have AMD and its MI300X chip, and Intel with its Gaudi 2 and 3 chips. They're not as powerful as the NVIDIA chips, those Gaudi chips, but they're also working on another called Falcon Shore. So we have Intel and AMD both pushing deeper into AI. And experts that I spoke to said, look, as far as the technology goes, these two companies could catch up very quickly to NVIDIA, despite the years-long jump that it had on them in getting to this space in AI. And so really it's the software aspect that's keeping NVIDIA ahead of the likes of Intel and AMD, as well as the hardware. But there's also the idea that, sure, there are rivals out there, other companies, major cloud companies in particular, as well as other firms, social media giants, are increasingly looking to build their own chips. And that's going to be a larger problem for NVIDIA, because those big name companies buy NVIDIA chips by the boatload. And so if they have viable alternatives to NVIDIA's chips, then that means that there's less of those major firms going out and buying NVIDIA's own offerings. So that's a potential loss as far as incoming revenue goes. So, when you're looking at this company, it really comes down to the rivals starting to circle as far as, look, we can do this too, why not? And then those companies that are increasingly looking to build their own chips with those rivals as well, Microsoft and AMD working on an AI chip, that really are part of the attacks against NVIDIA at this point.
So then, Dan, as rivals are potentially now looking inwards at developing their own chips, what does NVIDIA need to do then to keep its competitive edge?
Yeah, it really comes down to continuing to innovate. Look, they got on the AI train very early. When they were originally investing in the chips that now we see today, all of these companies buying up, and the reason why NVIDIA stock is doing well, they were innovating. They were working on this. They were working on the software. They were working on the hardware, looking for ways to improve and optimize. And at that point, investors, analysts were wondering why they were basically throwing their money away. There was no understanding that, eventually AI would explode the way it has. And so as long as they can continue to grow and innovate at the rate that they have, they may be able to fend off some of these challenges. But, someone that I spoke to had said, look, things in the chip industry are cutthroat and can change dramatically in an instant. And so, they really just have to be on their toes and ensure that they can keep Intel and AMD at bay.
I know they'll be looking over their shoulders. Appreciate that update, our very own Dan Howley there. All right, all your markets action still ahead. Stay tuned. You're watching Yahoo Finance.
Do you think that NVIDIA is a contributor to inflation?
That's a great question. I hadn't thought about that one. Perhaps, because I think there are some companies clamoring for their chips. It's clear from their results that people really want them, and it seems that companies are paying up for them. So perhaps it's tough. It's probably not at the consumer level, but probably somewhere in the PPI it's buried.
Gas prices will be watched with an eagle eye ahead of the Labor Day weekend, and the price at the pump is as much a national issue now as it ever was. With that in mind, we're looking at last week's GOP presidential debate. The candidates slammed President Biden's clean energy policies and Bidenomics more widely as being part of the problem. So who do we blame this time? The current administration, OPEC, Russia? Well, Yahoo Finance's Inez Ferrer has some insight. Inez, what are your thoughts?
Yeah, Rochelle. Well, first off, gasoline and diesel prices, those are expected to rise over the next week. Just taking a look at where we're at with the national average, what retail, the price of retail gasoline is at, it's at $3.82. That's a national average, but market watchers are expecting it to increase 5 to 10 cents in the next week. You've got diesel prices that are at $4.38 on a national average, and that's up from a month ago. That was at $3.97. Why is this important? Well, not only does this impact consumers, this also can have an impact, of course, on inflation going forward. Even Dollar Tree last week had noted a rise in diesel prices. It wasn't just a sales mix and their shrinkage issue. They also had noted that diesel prices were rising. So we have seen this on the rise. Now, we do have weather events that are impacting some of these prices as well. We had the hurricane or tropical storm in Southern California. We also have the Hurricane Idalia. That's expected to go into Florida. And that's not supposed to impact too much Florida because it's bypassing the refineries. However, it could impact tanker traffic going into Florida. The big thing to talk about, of course, is oil supply, because you've got OPEC plus cuts. And though the production numbers aren't as bad as the headline numbers are, so for example, Russia was voluntarily going to reduce its production by 500,000 barrels a day in August, but only is doing so by 300,000. So no surprise there, because you're seeing oil prices go higher, and Russia does need that money to fund its war. As far as the U.S. administration and what it's trying to do for oil prices, well, the U.S. wants to bring those oil prices down because, of course, we are going into an election year as well. There is some talk about talking with Venezuela to ease sanctions there, also negotiating a nuclear program with Iran. We have heard talks about this before, and you can see on our Wi-Fi Interactive, you've got WTI at $80 a barrel right now. Brent crude is at $85 a barrel. Andy Lippo from Lippo Oil Associates thinks that Saudi Arabia is going to try everything possible to keep this around $90 a barrel, Brent crude at $90 a barrel. So you've got a lot of sort of different forces going on here as far as these oil prices are concerned. But the bottom line is that the higher the oil prices, the more impact this will have on energy costs, and this is not good for inflation.
Excellent breakdown there. Yahoo Finance's own Inez Ferrer. Thanks so much, Inez. We've got all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
What are investors too worried about?
In some respects, the economy. In other words, low-end wages are killing it. Consumers doing great, and they've been sitting there fretting over the economy and not worried about asset prices.
It's just after 10 a.m. in New York City. This is Yahoo Finance Live. I'm Rochelle Akufa alongside Brad Smith, and we're about 30 minutes into the trading day. Let's take a look at how the stocks are moving. We're still seeing some green across the board here. We are seeing the Dow there currently in positive territory, also the S&P and the Nasdaq, all there driven up by tech. Now we're seeing stocks higher today as results season begins to wind down. Investors are digesting the results from big retailers and of course Nvidia last week. On the docket are some leftover tech names and specialty retailers. And for data, we await more housing data, plus the Fed's favorite inflation print, PCE, on Thursday, and August jobs data out on Friday.
Taking a look at some individual names, we have CrowdStrike on the move today after getting a downgrade from Morgan Stanley ahead of its second quarter results Wednesday. The bank now rating the stock equal weight from overweight and cut its price target to $167 from $178. The analyst saying that they expect the cybersecurity company's revenue to barely meet expectations for the quarter and that the consensus forecast for the second half of the year is overly optimistic.
And of course, we're also watching shares of Evergrande, which are trading for the first time since March 21st of 2022, when it was suspended. The resumed trading comes after the troubled Chinese developer reported a narrower than expected net loss in the first half of the year, thanks to a rise in revenue. Still, the company lost 33 billion yuan for the first 6 months, ending June 30th, adding to more than 582 billion yuan of losses from the previous 2 years. The stock is seeing a serious sell-off today in Hong Kong trading.
And JetBlue moving higher this morning after getting an upgrade from Evercore ISI. Analysts now rating the stock as in line from underperform. They, however, did not raise their price target, which sits at $4.50, more than 20% downside from its current trading price. Looking at the entire airline sector, Evercore said that they don't expect any revenue guidance raises, but the group feels washed out and oversold. Well, switching gears here, earnings season winding down, but we still have a few big names reporting this week, as well as some big data releases. Yahoo Finance reporter Josh Schaefer here with the lowdown. Where does your excitement level at this week?
Brad, we were just joking about this actually upstairs. I'm pretty excited still. I know it's the end of August. Okay. We don't have a lot on the calendar this week, but when you think about the calendar this week, we do still have some key economic data. I did want to start first with earnings though. So we'll start with earnings. Like I said, Brad, a little bit less exciting, but some fun stuff here. You got Best Buy on Tuesday. Curious to hear about retail theft and shrink there. That's been a big trend over the last couple of weeks. And then when you take a look at Wednesday, interested to hear from Salesforce. They've talked a lot about AI in the past. Curious if they lean on that again this quarter. And then Brad, one of our favorite companies reports on Thursday, Lululemon. I'm wearing the pants right now. You are not today, but some days you are. We're going to see how they've been doing. And I think the interesting thing with Lulu to think about is they normally have a strong high-end consumer. It's sort of like an Apple of retail, if you will. And if you think if a Lululemon's consumer is trading down or spending less, I think that'll tell us more about the consumer than maybe some of the broader retailers that don't have as direct of a market. But like I said, Brad, the exciting part this week is that economic calendar. When you take a look at what we have from an economic perspective this week, you can see it's pretty packed. And you take a look here, Friday is jobs day, Thursday, PCE inflation. Remember, that's the Fed's preferred inflation target. And then really it starts tomorrow when you have those JOLTS job openings. You also have consumer confidence. Remember, consumer confidence took that big swing up during the summer. We saw in the University of Michigan, which also measures consumer sentiment. That came down in August. So curious what we see from the conference board tomorrow. We're also going to have home prices. But for me, the biggest thing this week is that labor report on Friday. And I want to just zoom in on a couple of the numbers we are looking for to get you ready to go for this week. So when you take a look at the non-farm payrolls expected this week, you can see 168,000 expected that we added in August. That would actually be down a little bit from what we added in July. Unemployment rate expected to remain flat at 3.5%, with average hourly earnings going up to 4.3%. That would be down a little bit from last month. So the key things we're looking for here, if we're looking for the labor market to slow down a little bit, to keep cooling, you want to see this number around here, if not lower. You want to see unemployment actually probably tick up a little bit. We haven't seen unemployment tick up in a couple months. And average hourly wages. That is something we keep talking about, how much people are making. This is now pacing above inflation. So economists are looking for this number to also come down a little bit. But we have to wait till Friday.
All right. I'm not wearing my Lulu pants today. You're right. I did wear my jacket over the weekend, though.
You're going to wear them for earnings on Thursday.
Obviously, head to toe, for sure.
Bullish.
Yes. Josh, thanks so much for joining us today. Appreciate it. All right. With about a month until the September FOMC meeting, Fed leaders are sending some mixed signals about the next plan of attack on the sticky inflation situation. While Fed Chair Powell struck a hawkish tone in a speech at Jackson Hole, saying that they are prepared to raise rates if needed, not every member seems to agree. Philadelphia Fed President Patrick Harker said in an interview with our very own Jennifer Schonberger, quote, "I think at this point, just let things work through the economy. I think we need to give it a little bit of time, but recognize that not raising rates right now will still mean that we are in a restrictive stance. We're still putting pressure on the economy."
Meanwhile, Cleveland Fed President Mester says, quote, "Under tightening would be a worse mistake than over tightening a little bit because we can course correct that." So what can we expect from this meeting in a few weeks? Well, joining us now is a reporter with his finger on the pulse and known by many as the Fed Whisperer. We have Nick Timiraos there, the Wall Street Journal chief economics correspondent. So what do we make of this mixed messaging that we're getting from the Fed?
Well, I think it's pretty natural that at this point in the cycle, you're just going to hear more uncertainty over how much higher to go. I think, the important message out of Jackson Hole over the weekend is that the question right now is really about whether they have one more increase here. It's not as if you hear a lot of support for multiple increases in the Fed funds rate from where we are. I think the other message out of Jackson Hole, but there was a mood in the room of uneasy optimism. And that is, if you look back at where they were a year ago, where inflation was much higher and the policy rate was lower, they're obviously feeling better about the fact that they've got the policy rate higher. Nothing terrible has gone wrong in the economy so far, and you have lower inflation. But I think it was uneasy because there are still concerns of the policy lags, the effects that could still be felt from what they've done, and the fact that it still might take some time to get inflation down. There's some concern that we really kind of plucked the low-hanging fruit off the vine here, and that what remains could be harder to get.
Does this seem to you, Nick, in all of your covering of the Fed and all of your perhaps communications and interviewing some of the Fed members, voting or non-voting, like it's a Fed that is paying attention to the markets, that sees where the markets have moved, especially coming off of 2022, even through some of 2023 and the bounce back for some of the more kind of hard hit areas, and seeing that rise and now saying, for our own activity, that there is some paying attention to the equity markets, at least in their tenor or conversation, compared to when they were all on the boat of, we just got to get a handle on inflation right now.
Well, I think the degree to which they pay attention to the equity markets is probably overstated by equity investors. I mean, the Fed obviously does watch equity markets because, markets are forward-looking, and so there can be news there. But I think sometimes people overstate the degree to which they're watching that. The important point, I think, is when it comes to financial markets, they're looking more broadly at bond prices, credit spreads, and if you look at what's been happening there, especially at the long end, longer dated treasury yields are higher, and the Fed wants to see, and they've wanted to see, financial conditions tighten and stay tight. So I think one of the questions going into this September meeting is, how do the tighter financial conditions that we've seen play into their forecast, assuming that those higher yields are sustained and we don't go back down? How does that offset any stronger growth that we've seen? So stronger growth is something that could be a concern for the Fed. They've been expecting that you would get inflation down because the economy would continue to grow below the 2% run rate that they expect over time. And so if you have stronger growth, that would tell them maybe they need to go up again. But if you have financial conditions tightening, then you have to wonder, how do the two offset each other? To what extent do they cancel each other out? I think could be a pressing question going into September if we continue to see higher 10-year Treasury, higher 30-year mortgage rate yields.
And Nick, we do tend to see the Fed, most central banks move in concert together, but obviously very different pressures as we look at the pressures in global growth fueled by China. Also have the ECB with their own concerns trying to prop up the economy there over there in Europe. How much attention is the Fed paying to some of these other global headwinds?
Yeah, that was interesting that Powell in his speech on Friday did not mention any of the international developments. He didn't mention, for example, the slowdown in China. And so it will be a question perhaps at the press conference in September to what extent these international developments are playing into the Fed's thinking about the policy path and the outlook ahead. It's something that really hasn't come up very much in the commentary that we've been hearing from Fed officials. And, you know, there was some discussion over the weekend about the resilience even abroad, right? Europe, even though it looks like they're slowing down more now, it has been a big surprise this year that they weathered the winter as well as they did. And so I think that's something that we still don't have a great idea how the Fed is thinking about the impact from the rest of the world right now.
Nick, you said the word resiliency, and I couldn't help but immediately think about the employment situation and the labor market more broadly, which the Fed has been able to, in its dual mandate, kind of lean on in order to continue along their own policy pathway. With regard to that and that resiliency within the labor economy, how are they evaluating employment as a whole, and where do they feel like, you know, for exactly where they want to continue to kind of monitor where their moves have been digested by the economy, where that's also pairing with some of the future employment situation readings that at this point have continued to look pretty good in the employment economy?
Yeah, the jobs numbers have been good, but the pace of monthly payroll growth has been slowing. Mm-hmm. And that's something the Fed probably wants to see. They probably want to see that continue. Powell spoke in his speech Friday about how the labor market imbalances have eased somewhat, but he still sees a tight labor market. And so they would likely welcome continued declines in job openings in the survey that we'll get tomorrow, a slower growth in monthly payroll increases Friday. And, you know, it's a project. It's not something that you're going to solve with one or two more reports. And of course, these things, you know, when they slow down, they don't always proceed in a linear fashion. When job growth slows, sometimes the end comes quickly. And so I think there will be a lot of attention to any signs that things are turning over maybe faster than the consensus has been anticipating.
Nick, just lastly, while we have you, you know, in some of the conversations that you've had with some of the kind of broader Fed committee members, where are they kind of looking ahead to 2024? And given the fact that it is an election season, there is, of course, a heavy amount of conversation and dialogue on the campaign trails that you hear from candidates around the economy, and many of them might bring up inflation. Is the Fed at all concerned about what some CEOs are looking at as a potentially vitriolic election season in 2024?
I don't think that's going to be something that really enters into the conversation. I think when you look at 2024, the question for the Fed right here is, it's really one of tactics. You know, you mentioned, you ran the quote from Pat Harker, the Philly Fed president. And so he's laying out one approach, which would be to hold where they are right now and then stay there for longer. You're hearing other people who are maybe suggesting go up a little faster, and if you have to cut sooner than you think, then that's okay. And so I think those are the two tactics, the two different paths that are under debate right now. Is, do they really go with the higher for longer, which means maybe not going up anymore from here? If you're going to do a longer hold, you don't keep hiking. Or are you ready to consider cutting sooner because you think you may sort of kick off a sharper downturn if you keep going up? I think that's more of the strategic consideration that's being tossed around right now.
Nick, real pleasure to have you on with us this morning, and thanks so much for taking the time. Appreciate it. Wall Street Journal Chief Economics Correspondent Nick Timiraos. All right, and all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
What's your coffee order?
It's one of two. I have my venti Americano with Resplenda, or if I'm going to go more lighter for the morning, I go a venti breve latte with no foam.
So are you hot coffee through the summer, or that latter one is a cold coffee?
I'm a hot coffee guy, even in the depths of 115-degree summers here in Phoenix.
Nice.
As tech companies race to adapt and implement the latest and greatest in AI, there's a major roadblock that could prove detrimental to the new technology. We may not have enough power to keep it running. Now, giant data centers require a great deal of power to run and, crucially, lots of water to keep them cool. Some experts warn that the current electricity supply won't be able to keep up with the growing demand. William Cohen is a founding partner at Puck News, and he joins us now for more on this. So, I mean, we're seeing these large language models becoming very advanced very quickly. When it comes to memory storage and the need for more energy, how big is that gap between the ability to manage this with electricity?
Well, I mean, apparently the need for electricity is gargantuan, and already, and many of these data centers, of course, are related to companies like Google and Meta and Microsoft, which are on the West Coast in California, particularly in the case of Google and Meta. And California is already struggling probably to meet their needs, their electricity needs. And, these data centers require huge amounts of electricity. So, I happened to be speaking the other day to Steve Schwartzman at Blackstone. And of course, they are a big player in the owning and then leasing of data centers to Google, Microsoft, and Meta. And, he was talking about how it's quite possible by 2030, with the push in states like California to go all electric vehicles, that, California will run out of power, electric power, which is, a bit of a daunting thought process, I thought.
And so with that in mind, I mean, you just had energy as one of kind of the larger totem poles or pillars within the Inflation Reduction Act as well. Is it clear where going into 2024, this and AI and the need for some of the energy, or at least the supply that's needed for some of these data centers could play a role in kind of the campaigning or just where political lines kind of line up?
Well, it's of course hard to tell whether this will rise to the level of a political topic for politicians who this may be too in the weeds for most politicians. And by the way, it's not only electricity; it's also water. These data centers use a tremendous amount of water. I think Google said in 2022 it used 5.2 billion gallons of water to cool its data centers. So the combination of huge electrical needs and huge water cooling needs is sort of an acute, a growing and acute situation. I happen to also be talking to this very interesting fellow named Jeff Glickman at J4 Capital, who is a entrepreneur, a technologist, data scientist, and he has what he believes is solved some of the mathematical equations that will reduce the electrical and water needs in these big data centers, and he has applied for patents for his recent discovery. I mean, whether that will be one possible solution to this huge electrical and water needs of these data centers for AI purposes, it remains to be seen. But he thinks he's onto something, and I was thinking, maybe we need to put Schwartzman and Glickman together in the same room and see if they can solve some problems for the Googles, Microsoft, and Metas of the world.
I mean, and obviously we get a lot of pushback on some of these clean energy initiatives from Republicans. And speaking of one of the most famous ones, we've also had a date set for the arraignment of former President Donald Trump for September 6th. Now, this is, of course, part of the Atlanta criminal case where he's accused of attempting to overturn the 2020 election in Georgia. Bill, I wanted to get your take on this situation as it stands.
Well, I mean, he's sort of done the hard part, or several steps in the hard part, right? He's been indicted, and then he showed up last week to be, fingerprinted and photographed in that famous mugshot. The arraignment is another step in the process. So, September 6th, I guess he'll be back, and whether that will just be another, photo op and increase his popularity as a result of all of these indictments remains to be seen. I mean, it's quite a phenomenon that somebody who has been indicted 4 times becomes more popular and is more likely to be the Republican nominee. But we'll wait to see, honestly, because in 2016, at this point in the election cycle, we were talking about Scott Walker being the Republican nominee, the former governor of Wisconsin, with Jeb Bush being number 2. And the soon-to-be indicted Rudy Giuliani being number 3. So we know how that turned out. That did not turn out anything like what we're counting, or it seems like it's going to happen this time. So I think it's probably too early, but we have to see how these things play out.
Certainly, with a different headline coming out every other week regarding some of these candidates. I mean, as you mentioned there, November of 2024, a long way away. We do appreciate your time this morning. William Cohen, Puck News founding partner. Thank you for your time.
Thank you.
All right, stay with us. All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
If there was one streaming service that you had to cut, what would it be?
Oh, I have to admit, I've been a little annoyed with Max. It's so hard. Like, every time I want to download stuff, it's so limited. I find it challenging.
Have you finished everything that you wanted to watch on there, and now you're just kind of like, all right, I'm good to go here?
Yeah, I mean, I took a trip to Hawaii for a work trip, and I was on the plane so long, I needed more. And I have to share it with my husband, so that makes it challenging, because he wants to download a lot too. So
certainly,
yeah.
Magellan Midstream is betting big on natural gas as it pushes its $18.8 billion merger with ONEOK. Now, the combination would result in the fourth largest U.S. midstream company worth about $60 billion and is up for approval on September 21st. For more on this, we're joined by Aaron Milford, Magellan Midstream CEO. Good to have you on the show here. So talk about the timing of this. And obviously, anytime you talk mergers, you have to wonder, how likely is this to catch the eye of regulators?
Well, sure. It takes a little time to put deals like this together, that's for sure. And as we had the opportunity to consider this opportunity with ONEOK, it was really about two things. It was about maximizing value for our unit holders, and then also thinking about the future, what best sets up our company going forward. So we're a refined products and crude oil business today, primarily. It's a very healthy business. But when you think about the merger that we're creating, it'll be a refined products business, crude oil business, and then, as you mentioned, it'll also add natural gas liquids and natural gas to that mix. So as you look forward, we feel very, very good about how powerful this company can be as an infrastructure company as we look forward. And from a regulatory perspective, we've cleared the regulatory hurdles that we need to, and the vote that we have outstanding on the 21st is our last major hurdle.
And so, as a combined entity, how immediately do you believe that you're ready to go, kind of hit the ground running, and what type of fine tuning from an organizational perspective do you still think needs to take place?
Well, what's great is, our business is a little different than their business, refined products and crude oil. It's additive, they're complementary businesses, but they're different. So from an integration standpoint, we expect it to go very, very well. We'll bring our business into the mix. They'll continue to run their business really well. And then as we put the two companies together, we expect there to be significant synergies. So we expect about $200 to $400 million a year of value that we'll create from putting these two companies together that, frankly, neither one of us could do by ourselves. So that'll be the focus, integrating, running our business really, really well from day one, but then focusing on generating that additional value for all our unit holders and shareholders.
And it's interesting because this is a relatively fragmented industry in the US. What does having this consolidation in this space do? How does it position you against the competition?
So when you look at our space, it's been consolidating for a while. You've had a lot of smaller companies coming together to make larger companies. So as you look forward, it's all about having more ways to win. When you have a strong refined products business, a strong crude oil transportation business, and you add to that a strong natural gas liquids and natural gas business, you simply have more ways to win. So you have more ways to create growth and value for our investors moving forward. So, energy transition is uncertain, and the more ways you can adapt, the better off you're going to be as a company, and this merger allows us to do that.
When we think about where things stand right now in terms of kind of transitioning and the broader energy transition that is taking place, is this tie-up, is this deal and this ultimate merger a means to make sure that both of these businesses can not only complement each other, but at the end of the day, in the shift towards clean energy and cleaner elements of energy as well, that there's more of an opportunity for growth? And how do you kind of look at tapping into that as well?
So, energy transition, the world needs all the energy they can possibly get. And from our perspective, that's energy of all forms. It's fossil fuel energy, it's renewable energy, it's all of the above. That's what the world needs to have a successful economy. So as a fossil fuel company, we expect to have a very bright future in providing those fossil fuels the world's going to need. So as you look at that continuing demand in the world, it's all about getting those fossil fuels, natural gas liquids, refined products, crude oil, into that world market, not just our domestic market here in the US, but also the world market. And as we're able to do that, it creates opportunity because, again, it comes right back down to, we believe at the end of the day, we need all of the energy in all of its forms in order to be successful.
And Aaron, of course, we have to talk logistics and the role of AI. How do you see some of the advancements that you're seeing there factoring into your business? How much of an investment are you going to be making there?
Well, we've been focused on, really focusing on the data that we have as a company. We have a lot of information about how products actually flow in this country. So to the extent we can tap into that data and be able to predict when there's going to be, for instance, increased demand in certain regions or maybe lower demand in others, we're able to adapt much more quickly to those logistics to make sure that at the end of the day, the U.S. motorist, the U.S. household,
has the energy that they need, and it allows us to be more efficient in how we provide that. So we're definitely tapping into all the data that we have and finding all the different ways to make sure that Americans in the world simply have the energy that they need.
Aaron, while we have you, I'm taking a look at the stock year to date, up over 30%. When you think about the growth perspective for the company now, what would your message to investors be?
Well, my first point would be we have a really healthy business, but it's limited to refined products and crude oil today. And if you look at the business that we're creating with this merger, we'll have all those strengths that are inherent in our business, but we're going to add to them and add natural gas liquids and natural gas to the mix. So when you think about the ability to deploy capital in a way that actually creates value for unit holders, we're going to have more opportunity to do that. And that's some of what's behind the $200 to $400 million of synergies that we expect to get, again, from this combination that neither one of our companies could get by itself. So it's that increased growth because of increased opportunity that will be greater than what we have today as a standalone business.
And just lastly, from your perspective, you mentioned and acknowledged, being the CEO of a fossil fuel company. When you think about our own kind of mission and initiatives that you've heard across industries right now to have more clean energy, but also just to reduce the amount of emissions, what does that look like effectively at a business like yours?
Sure. Well, we as a company have reduced a lot of emissions through time. I think the efficiencies of how we use fossil fuels has continued to decrease emissions through time. I think that's actually a real success of the U.S. is how much we've decreased emissions from fossil fuel use while at the same time been able to continue to support economic growth. I mean, at the end of the day, we need the energy. And if we need the energy to have a healthy economy and live the lifestyles and help the world, frankly, grow their economies, let's make sure that we're using it really wisely. We're part of that solution. So that's what we're excited about. We know the world needs it. We want to make sure we're really responsible with how we provide it.
Absolutely. Aaron Milford, Magellan Midstream CEO. Aaron, thanks for taking the time here with us today.
Appreciate it very much.
All righty. We'll talk to you soon. All markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
What are investors not worried enough about right now?
The effect of interest rates sitting at 6%, 5.5%, somewhere around there for the next 12 to 18 months, and how tight that's going to make everything.
Talk a little bit more about that. What does that mean, how tight that's going to make everything? What are the effects of that going to be?
Shovels are not going in the ground because projects can't get financed for development in places like multifamily, increasingly in places like industrial, et cetera. So if that's not going on, that's going to have an effect on transactions and asset prices. And we could wake up with eventually the capital markets issue of funding spilling over into the real economy over the next 12 to 18 months.
All eyes were on Jackson Hole last week for the Fed's annual symposium as investors await the upcoming September meeting. Yahoo Finance's Jennifer Schonberger sat down with Philadelphia Fed President Patrick Harker to discuss his thoughts on the upcoming rate decision.
The data will dictate in the next few weeks what we do in September, and I have to be open to that. But I want to recognize that, first, people often think that we have different ends in means when it comes to the FOMC. We don't. We all want to get to the same place, 2% inflation. It's just a question of how to get there. For me, putting pressure on the economy, which we've done, I think we're in a restrictive stance, and keeping that pressure on is, from a risk balance perspective, to me, the right thing to do. Now, others may disagree with that, but I think at this point, just let things work through the economy. And I'm hearing this from a lot of my contacts. What I heard time after time, I was out in my district a lot this summer, and they all said, look, you've done a lot very quickly. Let us absorb that. Let us figure out, as bankers, what that means with respect to our loans and whether we're going to issue more or not, companies, whether they're going to make the investment or not, et cetera. So I think we need to give it a little bit of time, but recognize that not raising rates right now still means we are in a restrictive stance. We're still putting pressure on the economy.
We're going to get a couple more inflation reports between now and your September policy meeting. We'll also get another jobs report. If the data continue to show a cooling trend in line with what we've seen on the past couple of reports, would you be in favor of moving into an extended hold at the September meeting? Yeah, possibly. Yeah, I mean, I think at this point, that's where I am. If things change with those reports, if we're not seeing the kind of cooling, or if we see reacceleration, which I really don't see right now, then I may change my mind. But right now, I'd like to hold and see how things turn out. And how long do you see holding rates at these extended levels, right? Because the market thinks that you guys are going to start cutting in the middle of next year. Yeah. Is this more of a longer term phenomenon towards Q4? Yeah, so we clearly are going to hold through the end of the year, right? Next year, we need to let the data dictate that, right? We need to see what's going to happen. How are you viewing the bond market now? Because Treasury yields have surged to their highest levels since pre-financial crisis. I'm curious how you factor that into setting interest rates. In some ways, is the bond market doing your work for you? Yeah, so obviously the long end of the curve, there are a lot of factors, not just monetary policy that affect that. There are global factors that affect the long end of the curve. We just affect the short end of the curve. But yeah, it's doing some of the work for us for sure. And given that we're seeing nominal yields bump up above 4.25 this morning, real yields bumping up to around 2%. If we were to see real yields get above 2%, is that going to be problematic for the Fed? What are you targeting as far as the real funds rate? Yeah, we don't really target the real funds rate, right? We target inflation, unemployment. And so that's not one of the things, at least I target, and I don't think we collectively target. Again, if those rates were to increase, they will have clearly an effect on the economy, and that effect could be good or bad, depending. Once you get to the certain level where you're going to hold rates for an extended period, as inflation continues to fall, how will you determine whether the policy rate has become overly restrictive and needs to be trimmed? Yeah, we need to see clear signs we're moving toward 2%. Now, our view is we're going to get under 4 this year, under 3 next year, and in 2025 we'll hit 2. It's going to take some time. And I think we just need to be ready for that. It's going to take some time. That said, what I am really listening to is not just the data, the inflation data we get, but the soft data. What I'm hearing from my contacts throughout my district, and what I'm hearing from them is things may be, and I emphasize may, softening more than the data show. In that case, we'd have to react accordingly. But really, we need to see that play through the inflation data before I would be willing to take us off the hold. How much longer do you think this economic cycle of growth can play out? I mean, no one canceled the business cycle, right? But the economy has remained so resilient in the face of your 11 rate hikes. But as you said, some of your contacts may be seeing some softening than what the formal data are dictating. Softening, that's the key. It's not, what we're not hearing anywhere is that things are getting worse, much, much worse. There's softening. We've even seen in our recent manufacturing business outlook survey a little bit of an uptick after many negative months. So it looks like
we might be, our forecast right now is that soft landing is most probable. Not it's guaranteed, right? Nothing's guaranteed. But, I think we can this is possible for the economy.
I want to ask you about the relationship between wages and inflation.
Sure.
Because wages have really remained robust, even as inflation, while still high, is coming down. How do you explain that relationship? Is it that productivity perhaps is stronger than the data put on? Is it that the relationship has changed, or merely just a lag?
Yeah, I don't think the relationship's changed. It could be lag, it could be productivity. I mean, combination of those factors. Where it really affects the economy, in my view, is in services inflation, service X housing, right? That is where we're starting to see some signs that wages are starting to soften, which is a good thing, because that is the one area of inflation. We've seen good inflation go down. We're going to see shelter inflation come down just mechanically, right? We're seeing that happen. But the service inflation has been stubbornly high. As Chair Powell said in his speech today, it's basically gone sideways. Right. So we'd like to see that continue to come down. And I think we're going to start to see that. Part of it is there's more labor. You see this with the JOLTS data. The openings have been declining. And what we're hearing from all our contacts is it's much easier for them to hire people right now.
Okay. In terms of longer term growth, as you look out for the economy and the job market, really the dating culture has changed so that people are getting married later in life, and as a result perhaps having fewer children, which raises the question of population replacement absent proper immigration. So I'm wondering, what does that mean for longer term economic growth and job shortages too? Yeah,
that's a good question. One of my old colleagues, a very prominent demographer when I was a faculty member, would constantly remind me, demography is history. Demography drives much of the economy. It's not monetary policy, although important. Ultimately, long term, it's the population. So that's an issue for us. And there's a trade-off, right? You either get more productivity per worker or you get more workers. They're really the only two things you can do to increase growth. And in that case, immigration policy is not our business at the Fed, right? But it's clear what I hear time after time, contact after contact, is almost a pleading that some sensible immigration policy is put in place for the country. And you see this in, for example, wafer fabs are being built right now, onshore in the United States, but we don't necessarily have the talent to put the labor in there for them. So we really need to think comprehensively about, not only immigration, but also how to bring people off the sideline. The Philly Fed, we've been really focused on this with what we call the opportunity occupations approach. And we're really looking at jobs that pay above median wages that don't require a 4-year college degree. We have a tool, which is a great tool, the Occupational Mobility Explorer, where people can go in and say, with a little bit of training, what kind of job could I get in my region and what kind of increase in salary? We need to bring more people off the sideline who are sitting off the sideline, get them productively into the economy. The economy needs them. And they need to do it for their families and their communities.
Absolutely. And so what do you think this is going to mean longer term for rates? Actually, two-part question. One, are we in an era now where we're going to be seeing higher interest rates given where the economy is, given the strength of the job market? I know you expect cooling. And then two, given what we just talked about, what does that mean for the longer term for rates?
No, I think the longer term, so go back to 2019, before the pandemic. It's hard to remember what life was like then, given everything we've been through. We had low unemployment, low inflation, and trend growth. I ask myself, and I don't know the exact answer to this, but I ask myself, what's fundamentally changed in the economy, other than the demographic trends we're talking about, that would change the opportunity to go back to that situation? I think it's possible. I'm not saying it's for sure we're going to do that, but it's possible we could get back to that scenario. We've been there before. So we have a proof right there, right, that we've done it. And so I think we could possibly do that again.
To your point, I mean, the overarching theme here this year is structural shifts in the global economy. This, of course, coming off of the pandemic. I know we're early innings in the conference here yet, but having talked with colleagues, what are the takeaways? What are you hearing? What are your thoughts? I mean, to your point, the economy has changed greatly. You think we can get back to pre-pandemic? What are you hearing?
So that, again, this is the debate, I think, at the conference, right? What has really shifted fundamentally? I mean, lots of things. Geopolitically, things have shifted. I mean, the horrendous situation in Ukraine, the trade tensions we have around the world, and so forth. So those things have shifted. But net, and of course, the advent of AI and other technologies, but net, how big an impact will they have on the global economy and on the U.S. economy? That's still an open question, and that's what we're debating here.
That was Philadelphia Fed President Patrick Harker joining Yahoo Finance's own Jennifer Schonberger. The Federal Trade Commission is making it easier for Amgen to acquire Horizon Therapeutics. The FTC is suspending its challenge of Amgen's $28 billion takeover of biopharma company Horizon Therapeutics. Yahoo Finance senior reporter Anjali Khemlani has all the details for us. Hey, Anjali.
Hey, Brad. Happy Monday to you. So I wanted to start off with, first of all, of course, this pause from the FTC is good news for Amgen, which is looking to close the deal with Horizon Therapeutics by December. That is staying on track with the original timeline. Now, the FTC has paused their challenge of this $28 billion merger until September 18th. They're also still moving forward with an injunction hearing in September as well, and that's going to take place in Chicago, but the FTC did say in its filing on late Friday that it will consider proper resolution of this matter. Now, what the core of the problem is that the FTC is worried that with the takeover, Amgen has an opportunity to bundle its products with two in particular of Horizon's that would give it sort of a market monopoly and an advantage over potential competitors. Right now, Horizon does have, a really strong market for two areas of disease, one including thyroid eye disease. So as an example, that's what they're looking at, and that's what the FTC is worried about. Now, Amgen has repeatedly said it cannot because its slate of products is different than Horizon's and is administered differently, and so that's not an issue. But they did say in a statement following the news that, quote, we have been consistent with the commission, the courts, and the public that we have no reason, ability, or intention to bundle Horizon's, Tepezza, or Krystexxa with any of our products and will not do so. We would be pleased if our commitment were honored instead of going through a lengthy court process. That said, they're prepared to go to the courts and defend the acquisition. So that's where things stand right now. And of course, the September dates are soon coming up. So we will see if they reach a potential deal before then.
So, Angie, I mean, you have to keep in mind other companies probably looking for the outcome here. So how could the FTC's move on Amgen impact other deals?
There has been speculation that, because of the fact that the FTC did initially challenge this deal, it could affect others like Pfizer's acquisition, $43 billion acquisition of Seagen. But there are others who say that because they're a different issue altogether, it won't. But it is something still that the healthcare industry and the biopharma industry in general are watching. There are concerns that because of how aggressively the FTC is going after these mergers, that each and every one is something to keep an eye on, to watch what to look out for that the FTC is going after.
All right, Yahoo Finance's own Anjali Khemlani. Thank you so much, Anj, for covering all of that and bringing it to our attention here this morning. All right,
let's do a quick markets. Oh, you want to go ahead, Brad? I was just going to give us a quick markets check here as we're heading into the 11 o'clock hour. Looking at the Dow now, up about 190 points there, up about 0.6%, so seeing some gains there. The S&P 500 there also up, but that has pared back some of those gains, but currently up about 16 points. Tech-heavy Nasdaq also seeing a bit of a slowdown in the buying action, but still up in positive territory, up 0.4% or about 53 points.
Yeah, taking a look at some of the sector activity, continue just to give our viewers a little bit of a rundown as we approach the 90-minute mark of today's trading activity, which would complete your soccer match with plenty of garbage time left over in the trading session. Of course, some of the people looking for some end-of-day volume wouldn't like to hear that. But anyway, you're taking a look at sectors as of right now, which are largely still in the green here. It looks like we've just got one area that is showing a little bit of weakness here. As of right now, technology flat, but just barely to the downside. So we'll see exactly where that moves as we go in throughout the rest of the trading session, as that's just gotten back into positive territory. So 11 at 11, S&P 500 sectors in positive territory right now. Michelle.
Certainly investors have a lot of data to hold on to as they look ahead for the week. All right, stay with us. Yahoo Finance will be right back. Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo alongside Brad Smith. Here's what we're watching this morning. As we kick off the final trading week of August, where do markets stand and what should investors look to in September? We'll discuss coming up. And David Solomon is facing enhanced scrutiny, but it's nothing new for Goldman Sachs. We'll break down the bank's 153-year leadership history. Plus, with Dune Part 2 being the latest victim of the Hollywood strike, are other blockbusters at risk as well? We've got those details for you coming up this hour. But first, let's take a look at how the markets are faring an hour and a half into the trading day. As we can see here, as we're looking at Treasury yields here first, we're seeing the short-term yields there taking a little bit of a hit there, taking a look at the 10-year. That's also still above 4% for the 10-year, but obviously still down on the day about 0.5%. And looking at the longer-term 30-year yields, that's also down about 0.4% as well. But as we've been looking at the broader markets there, the Dow, the S&P, and the Nasdaq still in positive territory.
It's the final week of August, and for traders, that means, is it going to live up to the reputation as a lousy month for markets, or will there be something miraculous? Well, joining us now to explain where we stand is Yahoo Finance reporter Jared Blickery. Hey, Jared.
Hi there. We have a few more days for a miracle, but I'm not going to cross my fingers here. Let's take a look at the sector performance for what is now 20 trading days in the month of August. Only energy is in the green, and that's up only 0.1%. And then you can see healthcare almost break even, and industrials, which came roaring back in June, they are having a negative August and July, I should say. But check out the year-to-date totals, because we're still seeing substantial gains for the three mega cap sectors: communication services, that's first, and then tech, and then consumer discretionary. But on the month-to-date look, it looks like we're giving back some of those gains. Now, I ran the numbers, and we actually had really strong performance, about 30% up for the Nasdaq as of the end of July. So I took a look at what happens when January through July is up over 10%, but August is negative. And here we have these, we have 9 times in history when this has happened. We'll have to see what happens this time, and some historical precedents, which are pretty interesting. But overall, the average and median are both up over 9% for the rest of the year. That will be September through December. Not to get too ahead of ourselves, I want to show, I've been showing this graph. This is from Carson Investments, Ryan Dietrich over there. When we do have the S&P 500 up more than 10% by the end of June, we tend to consolidate in these months here: August, September, October, November. That gets us through prime crash season. And then you see there's a little dip here, and it's off to the races in November and December for that much vaunted Santa Claus rally. So this is what happens when the S&P is up more than 10% by the end of June. I want to show you a very similar chart that has nothing to do with that. This is the average year for the S&P 500 in the pre-election year in the presidential cycle. So we're talking about year 3 right now. And much like the other chart, we just tend to go sideways. This time, it looks like we got a little bit of a spike low in November, kind of retested into December, and then it's off to the races. But I think the point is a slowdown in August and maybe even September, October, when we've had a bump in year so far. That is to be expected. Now, I want to go over some of the leaders that we've had over the last 20 days in this month. Only energy, and these are some of the smaller issuers. This ETF right here is Invesco S&P Small Cap Energy ETF. Let's take a look at the 1-year chart. You can see pretty choppy action there. We did see energy, one of the huge winners last year, so now coming back into the rotation. But look at some of the biggest losers here. We have meme stocks. Those were going gangbusters in July, not August, down 24%. Taking a look at ARK, that is down 18.5%. That's a flagship ARK Innovation Fund. Solar, that's the TAN ETF, 17%. IPOs, crypto, cannabis, China, regional banks, chip stocks, it goes on. And so you can see we're just pretty much across the board seeing a lot of weakness. And I can even go into our meme stocks. So we've seen a lot of action there, but mainly to the downside. Some of the leaders, previous leaders in the space, you take a look at Robinhood, that's down 18%, maybe not the memest of stocks there, but we've also seen the APE shares and the AMC shares. Those have crashed during this month as well. Not even seeing them on this board just yet, but a few winners. For the most part, we've had to deal with a lot of losses, and some of these areas like the fringier parts of the market, well, those get hit the worst.
Well, thank you for getting us up to speed. Our very own Jared Blickery there. A lot of red across the board there for those meme stocks. Well, August is performing as expected, killing the summer stock rally and delivering a lousy month for markets. The S&P 500 has sunk more than 3% so far, on track to post its worst monthly performance since December. So should investors expect the same treatment from September? Our next guest says we should prepare for some disappointment. Joining me now is Sam Stovall, CFRA Research Chief Investment Strategist. Good to have you back on the show. So as we're looking at August performance and then looking ahead to September, is September saying hold my beer, still more damage to come?
Hello, Rochelle. Well, that's the question that everyone wants to hear. I think Jared did a great job of explaining what might happen based on historical precedent, especially with a strong market leading up to the August timeframe. And I think there's an old saying that you can correct in both time and price. And at the end of July of this year, the Nasdaq was 26% above its 200-day moving average. even General Patton never got that far ahead of his supply lines. So I think we need to either decline or we need to pause in order to let the moving averages work their way back up toward the indexes. And that's what's happening right now. So I believe that with the uncertainty leading up to the September 20th FOMC meeting, that could offer enough concern, uncertainty that would allow the markets to tread water.
Would an extended pause mean possibility or potential for inflation to once again rear its head, Sam?
Hey, Brad. Well, I think when we get the PCE numbers later this week, we might end up with a little bit of a negative surprise. Both the year-over-year headline read as well as the year-on-year core read is expected to show a backup and actually see a slight increase in the year-over-year readings. And so investors might not take that too kindly, especially in a very low volume week as we have Labor Day. So I still think that volatility is likely to be elevated, and it's going to only get worse in October. It's 35% higher in October than the average for the other 11 months of the year.
And so, Sam, as we look at the mid and small cap indices and how they fared, do they still have much further to fall from this point?
Well, they've certainly fallen a long way. And when you look at the valuations, whether it's on an absolute PE or a relative PE, the small and mid cap stocks are trading at more than 30% discounts to their average since 2005 versus the S&P 500. So they're looking very attractive. However, at this time of a bull market, small and mid cap stocks should be exceeding that of the large cap brethren. I think one reason that that's not happening is that the large cap tech exposure at 28% is more than twice the exposure that you see in the S&P small cap 600. So as a result, with the Magnificent Seven really leading the charge, it's leaving the small cap stocks in the dust.
When we continue to talk about the low volume that typically is at play in the last couple of weeks in August, and as we get close to the Labor Day holiday trading desks, a lot of investors there trying to make sure that they are using that vacation time. So low volume in this period. After that period, though, do you assume that into the fourth quarter of this year, we're expecting to see any type of outstanding move or conviction move in one direction or another?
Well, I'm sort of an optimist at heart. When life gives me lemons, I make whiskey sours. And so I'm a big believer in the Santa Claus rally, the fourth quarter, especially of the pre-election year. And as Jared also had mentioned about election years, looking at the election year of first-term presidents going back to World War II, every one of them has been positive. Not a guarantee, but certainly an indication that there could be some optimism associated with that.
So, Sam, where do you see the opportunities in this sort of environment?
Well, I think that right now it's those groups that were leading the charge, technology, communication services, consumer discretionary, that had the greatest gains and therefore the greatest profits to be taken during this market pullback. And right now, all sectors, benchmarks, sizes, styles are below their 50-day moving average. And as of Friday, we were looking at 9 of 11 sectors that were also below their 200-day moving averages. But I think once we get out of this seasonally choppy period and move into a Santa Claus rally and into the election year, I would tend to go back to growth.
Sam, why don't you line up 2 of those whiskey sours there? I'll have the other one. Appreciate the time here today. Sam Stovall, CFRA Research Chief Investment Strategist. There we go. Sam, good to see you.
Thank you, Brad.
All right, guys. Coming up as well, we got to take a look at this trending ticker, watching shares of Hawaiian Electric skyrocketing this morning. Take a look at that move, up 35%. This is after the company responded to a lawsuit filed by Maui County over the deadly Lahaina fires, saying that the suit is factually and legally irresponsible. And they are, quote, surprised and disappointed that the county of Maui rushed to court even before completing its own investigation, end quote. pointing to the county's own responsibility in the Hawaiian wildfires. That was part of the statement, and Hawaiian Electric stock has fallen over 60% in the last month as lawsuits allege the utility company's power lines were the cause of the deadly wildfires. The company has since said that its records conclusively establish that its power lines in Lahaina were not energized when the afternoon fire broke out. We'll continue to watch any movement upwards or downwards in those shares for you and get you an update.
Indeed. We'll still have all your markets action just ahead. Stay tuned. You're watching Yahoo Finance.
What are investors not worried enough about right now?
The effect of interest rates sitting at 6%, 5.5%, somewhere around there for the next 12 to 18 months, and how tight that's going to make everything.
Talk a little bit more about that. What does that mean, how tight that's going to make everything? What are the effects of that going to be?
Shovels are not going in the ground because projects can't get financed for development in places like multifamily, increasingly in places like industrial, et cetera. So if that's not going on, that's going to have an effect on transactions and asset prices. And we could wake up with eventually the capital markets issue of funding spilling over into the real economy over the next 12 to 18 months.
China stocks failed to hold on to most of their Monday gains as the latest effort to jumpstart the country's economy fell flat. Several U.S. sectors stand exposed to China's failure to relaunch. How hard will they be hit, and what will it take for the world's second largest economy to correct course? Joining me now with more, we've got Brian McCarthy, Chief Strategist and Managing Principal over at Macro Lens. Great to have you here with us this morning, Brian. First and foremost, why has it struggled? What is this sputtering kind of derivative of, from your perspective?
Well, obviously, China is beset by a lot of geopolitical cross currents and risks on that front. They're in a transition of their economic model away from credit-fueled growth to something they hope to be more value-added, but is not going to involve any kind of market-based reform. And against that difficult backdrop, the biggest housing bubble we've probably ever seen has just blown up. So this is creating a massive drag on credit extension in the Chinese system. It's putting the system at great risk for debt deflation, and it's going to have grave ramifications for consumer confidence and the growth level in the Chinese economy.
And Brian, I think a lot of times when people look at the Chinese economy, they look back at that breakneck speed. China's in a very different sort of growth pattern right now, but we seem to be in this phase narrative-wise of either China's collapsing or China's taking over the world. What are some of the important nuances that investors should keep in mind when they look at China's growth and how it sort of trickles down to the US economy?
Sure. So I'm sort of in the camp that China might be collapsing, actually. So, this property bubble, we're talking, potentially trillions of dollars in systemic losses. So we've gone from this situation where there were things like you alluded to. China's got demographic problems. China's been slowing consistently and steadily for a number of years. The investment-led growth model was basically, they had to invest more and more money in lower return infrastructure projects. And then they're dealing with this sort of budding trade war over the last few years with the US. So there were all kinds of structural problems that were weighing on Chinese growth. And I think the question now in the wake of the property bubble is this going to continue to be a gradual controlled slowdown? And I think that's sort of the market consensus, that Chinese growth might slow to 3%. Or something like that over the next 3 or 4 years. And in that scenario, the direct risks to the US are fairly limited. But there is another scenario in which that proves to be an optimistic case. And this bursting of the property bubble elicits a sharper, harder to control slowdown in the Chinese economy, where maybe their growth is negative next year, which I think is not an outrageous forecast. In that environment, you've probably got severe weakness on the RMB, which is then infecting other emerging market currencies. And as we saw in 2015, 2016, that kind of activity can generate financial market feedback on the West, which can have serious ramifications. So again, in the controlled slowdown, we're okay. But if it's worse than that, there will be volatility in U.S. markets.
Okay, and so just focusing in on what you were mentioning a moment ago, and perhaps what is the worst of the bear case scenario in a negative growth environment for China, where do you see that impacting some of the other U.S. companies even that have invested heavily into and have banked their own growth ambitions around success with the Chinese consumer and with the market more generally in China?
Yeah, I think we're going to find that a lot of Western multinationals have bad growth forecasts in terms of Chinese consumption. Chinese households are sitting on somewhere between 65 and 80 million empty apartments. That's about $10 trillion worth of real estate that's sitting there empty. And now we're seeing declines in Chinese real estate of, by some reports, 20 to 25%. This is going to get worse. So, you take a third of the value of the 10 trillion empty apartments, that's 3 trillion in wealth evaporating amongst Chinese consumers, particularly in the high wealth cohort. So pretty severe effects potentially for companies that sell luxury goods to Chinese consumers. But I think that the Chinese consumption story, again, just a lot of companies going to be stuck with bad forecasts there, because the Chinese consumer, I think, is going to remain under a lot of stress in the next few years.
And so, Brian, obviously very interconnected economies here. Which U.S. industries then would be the most exposed if there was suddenly a sharp negative downturn in China?
It's companies that do a lot of business in China. Like Starbucks has had good numbers because they have had a bit of a reopening boost to service sector activity in China. That has happened. It's just been swamped by other negative effects, mainly emanating from the property sector. But Nike, again, any consumer goods makers, luxury goods providers to China are just going to continue to see, I think, disappointing revenue numbers out of that market.
Especially when you have a nation of savers, any sort of economic downturn, everyone will sort of clutch the purse strings ever tighter. We do appreciate you joining us this morning. Brian McCarthy, Chief Strategist and Managing Principal at MacroLens. Thank you so much.
Thank you.
All right, you're very welcome. All right, well, let's take a look at another trending ticker that we're watching. American Airlines is getting hit with a $4.1 million fine from the U.S. Department of Transportation, saying the airline kept passengers on planes dozens of times without the opportunity to exit during delays. Now, this is the largest fine an airline has faced from the department since the implementation of guidelines for extended ground delays were enforced about 10 years ago. And Brad, so this is about the amount of time that they sort of keep people sitting on the tarmac, and not giving people a chance to deplane. So good news for consumers who are perhaps looking for some recourse, missing connecting flights. You have a lot of airline staff who are sort of, once they're off the clock, you might have to deplane and get on another plane. A win for the consumer, even though the dollar amount doesn't seem super significant.
Well, here's what's even more interesting about this. Earlier this year, American Airlines had actually implemented kind of an AI-generated rebooking type of system and add on to their service where if it looked like you weren't going to make your next flight or your connecting flight, that they would automatically rebook you, hoping to kind of cut down on the amount of time that people had to spend in lines trying to rebook through customer service, time spent on phones and so forth. And so now this enters the larger question of, okay, so how many of the passengers were actually missing flights because not only were they being held on the tarmac or sitting on that flight or the plane, and American Airlines, keeping them on that flight and them not being able to make that connection, but then on the other side, also having to wait it for a longer period of time to ultimately make their connection because they were automatically rebooked as well. So it's kind of a confluence of both the operation that they had changed up as well as what is being discovered here today with this $4.1 million fine for the ground delays as well.
And some of that was offset because some of that, about $2.05 million, was credited to the airline for some of the compensation that they did already give to some people who did have their flights impacted. But, a small number, but it is that warning shot that, the regulators are paying attention to this. So potentially we'll see more action. It might put more of these airlines on notice as well. Right, well, we still have all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Are high rates going to be a headwind for growth stocks? They were earlier in the year. They seem to have been less so more recently.
In theory, yes. In theory, high rates should be a headwind for growth stocks and value stocks to some extent too. But that divergence can persist for some time. And so if investors would rather focus on the sizzle than the steak, so to speak, then they don't become a headwind until it's really problematic.
Goldman Sachs CEO David Solomon has faced a heightened amount of scrutiny recently, but this isn't anything new for the 154-year-old bank. Yahoo Finance's David Hollerith joins us with the details. Hey, David.
Hey, Rochelle. At the moment, Goldman Sachs and CEO Solomon are dealing with everything from partner unrest, a slowdown in investment banking, and a big pivot away from consumer banking. And we wanted to look back at history for another angle on this. And we found that Goldman Sachs has been through plenty of other times of turmoil. And that might mean that the current situation is not quite as dire as some might think. And Goldman actually nearly went bankrupt in the 20s with the stock market crash in 1929. In 1976, its top boss passed away on the job without a clear succession plan. And in 1994, it faced a record amount of trading losses during a period of really high historically high interest rates. And partner Steve Friedman, or senior partner Steve Friedman at the time, stepped down abruptly, and that sort of led to a power struggle within the firm. Henry Paulson, who later became CEO, ended up leading a coup against Friedman's successor, who was John Corzine. And Paulson obviously eventually became U.S. Treasury Secretary during the Great Financial Crisis. So the point here being, with looking at Goldman through its 150-year history, is just pointing out the big differences between the current situation and those other times. And a big one is just structurally. Goldman Sachs is obviously a publicly traded company. During these other times, it was a private partnership. And so the situation was the partners had a lot more control over the business, about its direction. And they also had a lot more to lose. It's interesting, though, if you look at stories back from those days, especially the 90s, it's very similar to, the stories we've been writing and seeing in other outlets over the past year about Goldman. And now also because Goldman's now a publicly traded company, the biggest thing here is that the stock price is essentially what determines how well Goldman's doing, and its CEO Solomon, how well he's doing and viewed. As we know, the board sort of has the say as opposed to partners in this day and age.
Okay, so what should investors be keeping in mind about Goldman's current turmoil today?
Yeah, so Goldman's current situation is it's mainly a question of reputation, not so dire as some would think. Even the consumer banking business, which they're trying to pull out, is a pretty small part of their overall business. But that being said, the next 2 quarters are going to be really important to see how well Goldman navigates its pivot out of consumer banking. Analysts are going to be looking to see, obviously, investment banking, which they have a little bit less control over. They're going to be looking to see how that side of the business does, and then also how Goldman clears the decks, so to speak, of the parts of its consumer banking business that it's trying to pull out of. We're seeing once every week, it seems like that Goldman is selling parts of their consumer business, and this isn't overall bad. But we are going to watch to see how the losses mount. Second quarter, they had record high losses, highest since, record low profits, lowest since the beginning of 2020. So we're going to be watching the next 2 quarters to make sure that those losses don't continue to creep. RBC's bank analyst, Gerard Cassidy, is sort of called 2023 a lost year. So that's all going to be what determines Solomon's tenure at Goldman Sachs. But one thing I will point out is since he started in October 2018, Goldman has, its stock at least, has outperformed other Wall Street banks with the exception of Morgan Stanley, which I think is lost a little bit in the noise of all this, is that Goldman is still in a relatively strong position.
David, thanks so much for bringing this to our attention and continuing to monitor the situation over at Goldman Sachs. Yahoo Finance's own David Hollerith. Appreciate it. Well, switching gears, Hyundai is facing pressures from groups in Alabama and Georgia around labor conditions after undergoing an investigation from the Department of Labor last year, which uncovered violations of child labor laws. The auto company recently invested $5.5 billion in a new electric vehicle factory in Savannah. Yahoo Finance's own Pras Subramanian joins us now with more. Pras, what do we know about this one so far?
Yeah, Brad, you said it, man. That's $5.5 billion new plant coming in Georgia. I mean, EV and battery plant coming up. But in another plant that they have, I believe in Alabama, they had the investigation into the child labor law violations. So these union groups as well as labor groups, AFL-CIO, one of them saying that we want to ensure that there's safe labor conditions in the supply chain and the battery factory there in the new plants in Georgia, and they say they also want livable wages too. So they want to ensure that these things are happening. Lots at stake here, as the IRA passage has created a big incentives for companies to build factories in this in America. Labor saying, hey, we can't all get them to be UAW or union shops, but we want to make sure that they have livable wages and safe conditions for workers. I mean, the child labor stuff I thought was a pretty big deal when it came out last year. That was surprising and eye-opening to see that. How can you have children working in a car factory? Yeah. But it was happening.
And of course, Pras, looking ahead, the deadline is looming in the ongoing battle over the UAW versus the auto giants. What can you tell us about that?
Yes, at the end of the week, last week, the UAW got strike authorization from its members. There was a 97% strike vote, which is not surprising because we knew that was going to happen. And last time in 2019, the strike authorization vote was around 96%. So what that means is basically it gives leadership the ability to call a strike when the deal expires. So currently the deal is up till September 14th, and once that happens, the union can decide to strike or actually keep working together with the automakers to try to get a deal hammered out. So you're seeing some of the things that the union wants. We've heard about how they want wage increases of almost 40%. They want to restore cost of living adjustments. They want to get rid of compensation tiers amongst new workers and old workers. They want a defined pension plan. One of the things that they also wanted was a potential 4-day work week, which I think some people on the automotive side were shaking their heads saying that that's never going to happen. So they have a lot of high demands, big demands here, because they feel like the unions feel like they sort of compromised a lot back in 2008 when they wanted to help out the automakers during the great financial crisis. So they feel like now is the time to get what they're missing. And I think that we might see a very contentious battle up until the 14th, but no one knows what will happen. Maybe they'll get a deal. We'll see. But right now, the leadership is able to call a strike if need be past the 14th of September.
All right, Yahoo Finance's own Pras Subramanian there, tracking all things autos, mobility, and getting from point A to point B. Yeah. Thanks so much, Pras. Appreciate it. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
Here's a random one. What do you make of VinFast?
SPACs are back.
Are they though?
No, they're not. But selectively they are. I mean, VinFast has everything you'd want in a meme-like stock. I'm not going to call it a meme stock, but it's electric cars. It's a very thin float. It's non-U.S. based, and some of we've seen much more crazy trading in some of the new listings that have come out of Asia rather than the ones that are domestically focused. And so you've got all the ingredients. Is this company worth more than Ford and GM at this point? It seems ridiculous, but that's not. If you're trading VinFast or if you're investing in VinFast, you're not thinking in those terms. You're saying, oh wait, this stock can double in a day or triple in a day, and if it goes down 50%, maybe it'll come back next time. So which it has exactly. So you've had everything in its short lifespan.
Yeah.
Let's get to a part of the business world that still has a lot more work to do. We're talking about women in leadership positions. Now, here in the US, women account for about 30% of board seats. That's less than a third. Sure, 34 more seats were added in the first 2 months of this year for S&P 500 companies, but we're still not even close to where we should be. And of course, we can't forget about the gender pay gap that hasn't changed much in the last 2 decades. Women still earn 77 cents for every dollar men earn for work of equal value. Our next guest says we will never have full equality if we don't have financial equality. Let's bring her in. Tracy Burns, financial advisor at UBS, joining us now. Thank you for joining us, Tracy. So break this down. I mean, it was Women's Equality Day just on Saturday here. Why is the gap still not closing at a fast enough pace here?
Yeah, first of all, shout out to your producers. That was a beautiful segue. But I will say a lot of it has to do with the fact that women are still abdicating financial decisions to their partner, Rochelle. And I'm not sure why, except that life happens and we tend to delegate responsibilities. And sadly, we don't meet back at the table to discuss them. You know, while we have to celebrate the women that fought for our right to vote, the Women's Equality Day has sort of evolved into this, you know, day that we shine a light on a ton of advocates who are supporting women's equality. But as you pointed out, if we don't have financial equality, we'll never be equal. And that doesn't necessarily mean, Rochelle, that you need to earn the same amount as your partner. It just means you need to all be on the same page. And that's where the gap is.
You know, what's really interesting, too, is even as we look across the disbursement of so many homes, so many families and jobs over the past couple of years following the pandemic, as there's been more virtual employment or hybrid employment, too, begs the question, has there been any moderation? Has there been any kind of reassessment? And how does that factor into the livability, into where people have migrated towards? And I thought that was particularly interesting as part of this most recent report, where women are finding the best wages.
Yeah, so we started this research. Our chairwoman launched this back in 2018 just to get a sense of what women were doing and what they weren't doing, quite frankly. And Brad, to your point, post-COVID, more women said, I really should figure this out. I really should learn about this for the sake of my family. Still not getting off their hands, by the way, but they're starting to realize they should. Now, our most recent iteration, we looked at women now who are breadwinners, because more and more households, women are bringing in the larger paycheck. They're still abdicating, Brad. And I think a lot of it has to do with the fact that women, especially in heterosexual couples, are still taking on those traditional gender roles, right? So we work all day, we come home, we got to make sure that Johnny has his lunch and, you know, your daughter has her ballet slippers and all the things. And you turn to your partner and like, please do something. And so you abdicate the long-term financial decisions because you know in your heart, well, that's not gonna hurt the wheels on the bus. I need to keep the wheels on the bus moving here. Short term, long term, let's push that off. The problem is they never come together. You know, I often say, think of your household like a small business. If you were to delegate something to a worker, you would one day once a week have a meeting and say, so what'd you learn this week? And I think households need to do this more and more. You do not need to earn the same as your counterpart in your household, but you need to understand what you have, where the money is, and how to access it.
And Tracy, it can be hard because having these financial conversations, a lot of people don't even have them before they get into relationships. How do they sort of reset that so that they can really take more empowerment of their financial decisions and perhaps do a little more to close the wage gap?
Yeah, so 2 things. One, it is not rocket science. Like, don't be afraid. I think so many women think they need to be a professional to ask. And I say women, people in general are afraid to ask the questions. It's okay. I mean, if you're having your gallbladder out, you're going to ask a lot of questions, right? Women ask 50,000 questions on how to get their butt firmer, but they're afraid to ask what's in their bank account. Ask questions. That's first. And second, I would say schedule time with your partner. If you're going for a walk or if you're going out to dinner, just ask one question. You don't have to make the whole conversation about money, but one question. Do we have life insurance? Where is it? How do I access it? If you have kids, how are we paying for college? Do we have 529 plans? If so, how do I access them? And if you do nothing, please go home and find out all the usernames and passwords to all your existing investment accounts. Because I'm Sicilian, we say, God forbid, your partner gets hit by that proverbial bus on the way home from work, do you know how to find the money you have and access it? And if you can't answer those questions, that has to be your starting spot, Rochelle.
Tracy, while we have you as well, I mean, we want to get your reaction to this clip. Our very own Jennifer Schonberger spoke to former Kansas City Fed President Esther George at the Federal Reserve's annual economic symposium in Jackson Hole, Wyoming last week. Take a listen to what she said on the gender pay gap, and we'll get your reaction.
Women have to continue to do what they've been doing. They've made progress. I think they are getting more visibility. I think companies are beginning to see the opportunities, ways to include women. We've done that at Jackson Hole in terms of bringing more visibility. So I think those are going to be the kinds of things where skills are in high demand. This is a time of a tight labor market that you would hope to see some of those kinds of gaps closing.
And Tracy, just want to get your reaction to what you heard from Esther George there.
She's 100% right, but I still think that we will have childcare issues in this country that we haven't addressed. Coming out of COVID, so many women did not go back because of childcare. There's no argument that we're just as smart, just as intuitive, just as entrepreneurial. That's a no-brainer, right? But how do we split this division of labor at home? I think that is forever going to be the hardest thing for us to nail, because so many women do. Look, I stayed home to take care of my kids when they were little, and I would not want to ever have missed that. That said, though, I have less money in Social Security now because of it, right? Because I stepped out of the workforce. So we as a country have to do a better job and figure this out better for the women, the mothers, all the caregivers that stay home, because that will be the part that forever keeps us from true equality.
Tracy, just lastly, too, when we think about what companies can do here, I mean, we've heard about companies saying that they're going to have more child care services that parents can tap into and bring children on site, or we've heard them even step up to the plate when there was a SCOTUS ruling last year that meant that for many of their employees that would have to cross state lines just to get certain type of health care or procedures, that they were going to step in the gap there and help out. So what more can companies do as well to ensure that we are not only closing the gap and fighting more for equality, but also that companies are stepping up and taking on the task as well?
Yeah, it's interesting, right? Because I think post-COVID, so many families had this, life is too short conversation, and I don't want to commute an hour a day, and I don't want to have to, be out of the home if my kids are little and they're still here. So I think families are trying to figure it out still. I do think companies have stepped up. I think the hybrid situation has been super helpful, but we're still missing the mark a little bit. And to your point, we want corporate support, but I also think that that's why we're seeing a lot of female entrepreneurs coming to the table, because they're saying, you know what, if I can't get it in the confines of an office building, I'm going to create it myself. I think we need to get out there and support female entrepreneurship. We need to back these startup companies, because so many women are trying to create the professional and personal lives that they truly, truly want, that will help benefit their families the most. And maybe we could get behind that a little bit more as a country as well.
We'll certainly hope that that hits the ears of all the women out there, and as well as the employers out there who could be supporting some of these women a lot better as well. A big thank you there to Tracy Burns, UBS financial advisor. Thank you so much.
Thank you.
Well, the prolonged actors and writers strike continues to shake up the box office. Warner Brothers confirmed that its film Dune Part 2, the sci-fi sequel starring Timothée Chalamet and Zendaya, is pushing back its release date as the strikes linger. For more on this story, we're joined by Yahoo Finance senior reporter Alexandra Canal. So, Ali, Barry Diller says the strikes needed to be settled by September 1st, otherwise there won't be many movies for anyone to watch next year. So where do things stand now?
Yeah, well, Rochelle, things are still at a standstill at this point, and that September 1st deadline, I do think it's a relevant one, but rather it being a hard and fast line, I think it more so represents if writers are not working on new projects now, we're not going to be getting any new content come the new year, and that's going to drag revenues down across the board. And you know, for the studio side, I think even compared to where we were a month ago, you're certainly seeing a little more urgency there. They're starting to really worry that they're not going to have that content to aid subscribers and fuel that revenue growth. But there remains critical areas where the two sides just don't align. Number one being artificial intelligence and the use of AI in entertainment. The writers want to guarantee that studios won't use their scripts to train AI, whereas the studios don't want to set a precedent given how new this technology is, in addition to the fact that they're saying they own the scripts. And then separately, there are other issues like minimum staffing requirements. Studios are saying that should be up to the discretion of the head writer. And then streaming residuals, another big sticking point. Writers want pretty hefty bonuses if their shows and movies do well on these streaming platforms. Seems like that should be the case. However, studios just simply don't have the cash to commit to what they want at this point. So a lot of unknowns, a lot of TBDs. There still seems to be a hefty amount of friction, and that's going to mean more economic losses down the line. Milken is saying that 4 billion projection of losses, that could balloon to 5 billion. And, you know, we're only in a few months of the strike. If this continues through the end of 2023, it could be devastating. And you're already starting to see the cracks begin to show with that Dune film delayed from November of this year to March of next year. And if you think about the box office theatrical release schedule, this is one of the most anticipated movies of the fall. Now that's gone. So you have to think that these theater chains, the box office in general, they're going to be strapped for a lot of those new content.
Indeed. I was looking forward to seeing the sequel. I mean, the first one was a little bit long, but I was looking forward to seeing this. But if we're going to end up with like this drought...
A lot of long movies right now. Oppenheimer.
It's true. It's true. But I guess we'll see how it all plays out in the fall and beyond. Appreciate that update, our very own Alexandra Canal. Thank you so much. All right, shifting gears now, Fed Chair Jay Powell has spoken, but the rates debate rages on, with November emerging as the key FOMC meeting. Now, one voice which has been measured over the past year is former Kansas City Fed President Esther George. Now, she's been notable in seeking a moderate pace of hikes and has warned against oversteering. Now, she sat down with Yahoo Finance's Jennifer Schonberger. Take a listen.
He met my expectations. I knew this would be a widely anticipated and watched speech. And so I think for him, very important to reinforce messages that he's been giving and that the committee's been giving, which is we remain squarely focused on that 2% target. We see how the economy is performing. And there's some uncertainty here. And so we want to make sure that markets, that the public know we haven't given up on 2% and we'll continue to watch that.
Many have said that he was moderately hawkish. We know that the Fed is data dependent, and Chair Powell emphasized that again today. If you look at the data, it's been quite strong, quite resilient. Do you think that spells a higher rate hike path than what was put forth in June?
Well, I think if you listen to his remarks today, he laid out a couple of options there to say it could mean more rate hikes down the road. It could also be a call for patience. And if you think between now and the September meeting, there will be more data that comes in. I think that's going to inform how this committee thinks about what the next steps were. We've heard today about the uncertainty. People are very pleased, as am I, that the economy looks resilient today. But there are lags to this policy, and a lot has been done that I think this committee, wisely, is wanting to see how it unfolds.
Chair Powell says he's encouraged on inflation, but there's still a lot of work to do. We're going to get a couple more inflation reports between now and the September policy meeting. Do you think that's going to be enough for the Fed if those reports come out as the last couple have to move into an extended hold, or do you think they would opt to wait till November and collect more data?
Yeah, I mean, if it were me, I think you could wait till November. I think he made the point today, we've had 2 months of data that were encouraging, but it doesn't yet make us convinced that we're on the right path. And I think one of the lessons from past committees is you don't want to declare victory too soon, that you want to keep your eye on that inflation and really have a level of confidence. So I think there could be a number of things. They'll be watching the labor market carefully. They'll be watching those data prints on inflation. They'll be looking at what's happening in the broader economy to try to understand where they might be.
And to your point on the labor market, Powell said if we don't see further easing, that could require a monetary policy response. So obviously inflation has been the number one thing that the Fed and much of the markets have been focused on. But if the labor market remains strong, what do you think that spells for policy action?
Well, the labor market's an important indicator of the health of the economy. It's very tight right now. There's been some softening. I think one of the things in the anecdotes they hear is that businesses are less concerned about some of the very aggressive wage hikes they had to make, which may mean there's better balance coming in between workers' expectations and inflation. But job vacancies have not softened the labor market enough to bring inflation down. So I think these imbalances that have been the theme of this conference are going to be really important to watch. Supply is helping some. The Fed has a job to do with its rate increases. How much more? I think they're being very open to watching the data.
So to your point, getting to the peak on rates is one thing. How long you hold for an extended period of time is another. How long do you think the Fed will remain on hold? Do you think we'll see really a 5 handle on rates through 2024?
Yeah, I'll be very interested in the SEP or those individual projections that the committee will submit in September. I think even the last set of projections suggested people thought 2024 would allow them to begin to back off of some of those rate increases. So that's why I think the coming data releases are going to be really important to them to gauge, are we holding longer? Really, I think the experience of this past year has been to push out some of the concerns, whether it was worried about recession, whether it was worried about, pain in the labor market, that continues to be pushed out. And it could happen again, I think, with this next set of projections.
So we've seen so much resiliency. People are now calling for a soft landing instead of a recession. How much longer do you think we can continue with this? I mean, no one canceled the business cycle, right? So what's it going to take?
So one of the things I think about are the lags. And there's, been a debate about whether they've shortened because of financial markets and communication by the central bank. And that may be the case, but I think there is still more to come. When you think about how aggressive last summer the committee was, they've made additional hikes. That I think you're going to have to wait and see. That can take up to 18 months, which suggests we may be through the end of the year before we begin to see further effects. And that's why I think there's a good case to be patient right now before you make a call on whether more rate hikes are needed.
Switching gears, I always like to ask women in economics this question. Saturday is Women's Equality Day, and there still exists a major pay gap. Women are making 83 cents on the dollar versus men who are in full-time positions. What is your thoughts on how we can close the gap?
Yeah, I think women have to continue to do what they've been doing. They've made progress. I think they are getting more visibility. I think companies are beginning to see the opportunities, ways to include women. We've done that at Jackson Hole in terms of bringing more visibility. So I think those are going to be the kinds of things where skills are in high demand. This is a time of a tight labor market that you would hope to see some of those kinds of gaps closing. But it's an important issue. It's one that's been with us a long time, and no silver bullets on how to address it other than to keep it in front, I think, of the public's attention.
That was, of course, former Kansas City Federal Reserve President Esther George speaking there with Yahoo Finance's Jennifer Schonberger. Well, that's it for now. We'll be back with you tomorrow. I'm Rochelle Akufo, and thanks to Brad Smith alongside me here. And we'll see you tomorrow on Yahoo Finance.